Okay, good morning, everyone. Today, being Sunday, the 19th of March, 2023, I will be having discussion with you on the aspect of financial reporting. And the aspect of financial reporting I'll be having discussion with is with respect to financial statement analysis. And peradventure, the second part of the session, we may commence our discussion on earnings per share in line with requirement of IAS 33. Okay, it's going to be an offshoot of whatever discussion we've had within this initial session on financial statement analysis. Okay, in this case, I'm going to more or less share my screen for what we'll be looking at today. Okay, I believe you guys have a copy of the material, but regardless of that, don't let it distract you for now. Just focus much more on what we'll be discussing. Okay, now when we talk about financial statement analysis, what we are trying to do is that information that is provided in absolute terms with respect to financial information in the financial statements, how do stakeholders or users of financial reports make meaningful understanding from it? And the essence of that is to allow them to make informed decision, okay? And there's a limitation in financial statements you present. The limitation is much more based on the fact that most of the information provided are information that are in absolute term. When we say absolute term, what are we talking about? They are in numbers, they are in figures. And most times you might be able to make right decision, and sometimes you might be making wrong decision based on the same information made available. And why is that so? Is because absolute term presented in the financial statement may mislead, especially when you have to make comparison, because they might not necessarily be on the same pedestrian. I'll give you an example. If you are faced with an investment option and you are to invest in one of the two companies, which means it's mutually exclusive, and the profit of company A seems to be 10 million naira, the profit of company B seems to be 12 million naira. The question then is, which of the company will you invest in? If you go by absolute term, most people will make wrong decision by going for company B of 12 million naira. Why? Because company B seems to have higher profits than company A. But we fail to ask some questions. Some of those questions is that, okay, let me show you in relative terms. Let me put on the Excel so that I can see it. Let's say we have company A. And I have company B. The profit of company A is 10 million. Naira. And profit of company B is 12 million naira. Now, which company are you going to pick? Most people, based on this limited information, may prefer to pick B. Okay? And they are picking B, assuming all other things being equal. But the reality is that all other things are not necessarily equal. Why? The capital invested in company A, for example, maybe 50 million. Whereas the capital invested in company B may be 80 million. Relatively, let us compare what the performance might be. Let's say return on capital. Now, return on capital means that if you've invested 50 million and you earn 10 million as profit, what then is the proportion of the profit to the capital invested? And that's, for now, we'll say is a return on capital. Okay, if that is the case, I can say, okay, what is the ratio of profits to capital invested? And I find out that this is approximately 20%. That is for company A. For company B, what will it be? Is 15%. In this case, the relative analysis is changing our decision to say, no, I'd rather go for company A than going for company B, because if I've invested just 50 million to earn 10 million, it then means that I will have earned far more than 12 million if I invest the same 80 million in company A. Let's see, for example, assuming now we invested 80 million in company A as against the initial 50 million. It then means that company A will give us return of 20% on 80 million. Let me put the 80 million here. Therefore, alternatively, the profit I will earn is now 60 million, given this position, which means investing in company A is better than company B in relative terms. And that is how decisions are expected to be made. Because absolute term may not necessarily put everything in the same platform or on the same platform or on the same basis. Therefore, we need to use relative analysis to be able to reach a logical and informed decision. And in trying to do this is why we have financial statement analysis. Analyzing most of the information in the financial statement in relative terms in order to provide more informed decision and logical decision that debase all of our parameters and make them unitary. And on that basis, that is only where we can make effective decision. And that's all what we are trying to talk about. Now, in trying to do this, we can carry this out based on various methodologies, okay? When I say financial statement analysis, everything about it is relative analysis. Now, what it simply means is that I have various methodologies I can adopt. The first and the most popular out of them are financial ratios. The next that follows them suit are common size analysis. followed by what is used at the extreme top layer, which is the multivariate analysis. This is not common. These are only being used by analysts in trying to predict the possible corporate failure in the immediate near future of an entity. And we're going to see that based on various approaches, disease cause and the like. Okay, we also have graphical analysis, which in today's world, you could call them infographics. Okay, which means infographics, or if you are a modeler or a data analyst or data scientist, we use the word visualization. Okay, infographics is much more used for presentation when we come to PowerPoint, while visualization is much more dynamic, which we use when it comes to Power BI, Excel, Google Sheets, Tableau, and the like. Okay, these are all what we'll be discussing here in the course of our financial statements analysis. Okay, at this point, I'll switch back to my material. Okay. Now, going back to the material, we'll be asking ourselves simple questions. Okay, the questions border on what do we tend to understand or appreciate, or what is the objective of trying to make use of this analysis, relative analysis. Okay, and I more or less look at it from three perspectives. That is our ability to answer three questions. Okay, the first question I portray is that how successful has a company performed relative to its past performance and also relative to its competitors. This is more or less like you are benchmarking your performance with your past record and your performance with your competitors. The other question then is, how is it likely that a company will perform in the future? And again, it has been said that to a higher degree, your past determines a greater percentage of your possible performance or outcome in the future, even though changes might occur, but it's relative, okay, subject to other changes or fundamentals within a larger economy. But again, your past play more role about your future in an average case. The last question also is that based on your expectation about the future, what is the value of the company or its securities? Which means you'll find out at the end of this discussion that one of the key, if not the most important metric for market approach valuation of businesses is a key fundamental ratio that we'll be discussing, which we call PE ratio, price earnings ratio. It's much more fundamental in valuation when it comes to transaction analysis. Okay, we are going to look at all of this, okay? And as I've said earlier, there are various tools that we will be using. Financial ratios, common size analysis, multivariate analysis, and graphical analysis for visualization. Okay, we'll start with the fundamental here, which is the financial ratio. Now, financial ratio, or what some people call accounting ratio, okay? Some people call it accounting ratio. Let me switch it to where I typed it. Accounting ratios. Now, what do you want to discuss about this? Now, accounting ratio is more or less making comparison, making relative comparisons between two variables. What does that mean? It simply means that a ratio is just comparing A over B. A being the first variable and B being the second variable, which could be anything. And that's ratio, which means ratio is otherwise known as proportion. Okay, but in accounting, we call it ratio. Okay, you can build ratio on anything, but today we'll be restricting ourselves to ratio that tends to measure financial indices and metrics. Now, these financial ratios come with its own benefits and also come with its own limitations, as I would say. Now, what are the benefits of ratio? Now, as we have done earlier here, where we did the return on capital employed, we discovered that ratio will serve us more benefit with respect to relative analysis, so that we are not making uninformed decision or a wrong decision. Because before now, we would have gone for company B just because company B absolutely has 12 million profits when compared with company A with 10 million profits. But unknown to us that to generate that 12 million, company B has invested 80 million, whereas in generating 10 million, company A has only invested 50 million. Now, if not for this relative analysis, we won't be able to make the informed decision, which is proved by assuming company A can equally invest 80 million, giving other things constant, it will have generated 16 million, far higher than 12 million of company B. And that's what we are trying to achieve, one of the benefits. Ratio also is a tool for communicating financial performance in a way far understood by non-sophisticated users of financial reports. Okay, remember that stakeholders are not necessarily going to be of equal knowledge or equal capabilities. Therefore, your own responsibility is to provide information to the bare average on how they can make meaningful understanding from whatever the company performance is, and on that basis, they are able to more or less make informed decision. And it's easy for people to make decisions when they are faced with just tiny and the unit variables, and they can easily say, okay, between you getting 20% return or getting 15% return, which one do you prefer? Naturally, everybody will go for 20% return, and you have simply answered all of the questions. Rather than saying, if you invest 80 million, you get 12 million. And if you invest 50 million, you get 10 million. Not everybody can now go further step in analyzing what you said and make more meaning from it. And that's what we are trying to do here. Okay, another thing there is that this ratio assists companies from a macroeconomic perspective, microeconomic perspective, to more or less project earnings and their cash flows. which means if you have seen trend of your past performance relatively, you can use such relative to project absolute position in the future, which some of us are familiar with when we talk about financial modeling, which is you are modeling and forecasting about the future based on relative historical data. Okay, also a company's flexibility or the ability to obtain the cash required to grow and meet its obligation. Okay, and in this case, ratio analysis more or less provide a meeting point for all stakeholders to have the same understanding without any ambiguity or confusion in arriving at similar decision, being rational investors or being rational in their decision making, which means this is not like economics or like law where you can be arguing things from different perspectives. What happens is that when you talk about relative analysis or ratio analysis, you are given an exact points based on the fact that you have debased and everything now are on the same pedestrian or platform of measurement. And in that case, the same meaning is expected of whatever the outcome of that analysis is. These are just what we need to take note of. Now, looking at financial ratios, there are different perspectives to which we can look at these ratios. You can look at this ratio from this perspective of we can start from profitability. Now, when we talk about profitability ratios, we are talking about ratios that measures returns, which means bulk of it is measuring your profit as a ratio of something, or because you want to achieve a position of understanding how profitable a company is compared to another, and what form of return can company A give me relative to company B. Okay. Also, you can look at it from the perspective of short-term solvency, or what we might term liquidity ratios. And this is looking at it that profit is on one hand, which is different from cash flows. As we have discussed within IS1, where we started, and in the conceptual framework, we discovered that you might be profitable as an entity, but you are not liquid. And also you can be liquid as an entity and you are not profitable. And it's also possible that you are liquid and you are also profitable. And likely it's possible that you are not profitable and you are also not liquid. But the question then is, you want to look at it, what is your ability to meet your short-term obligations as a fall due? And that is the objective we'll be looking at for on that short-term solvency. Apart from that, what creates liquidity is as a result of activities, or what we call working capital. Therefore, we look at activity ratios, which also can be considered as working capital ratios. Now, before I go there, the profitability ratio can equally go by way of sometimes management efficiency, because management efficiency is coming out of being profitable. It can also be coming out of working capital, as the case may be. But what is working capital ratios? Working capital ratios is looking at it that the operating cycle of a company is determined by how it's able to turn over its goods or services towards generating cash, and the activities that give rise to that. Such activity will be activity that borders on purchase of inventory, the period between requisition lead time, and if it's a manufacturing, up to production processes to turn out finished goods, up to the inventory holding days before customer picks them up by way of purchases or buying those items. Also, it flows through credit period where customers make payments for what is due. And likewise, from the collection you make from customers, you are able to meet with your own payables within your payable period. And all of these things create a cash cycle. And the question then is how efficient you are within that cycle is what will create liquidity. What that means, liquidity does not just arise, it's as a function of the management activity of certain variables, which are your inventory management, your receivable management, and your payable management. And we're going to see those ratios later on. Now, the other aspect is long-term solvency. Or what we call stability ratio. Some people may call it adequacy ratio. And this is an offshoot of short-term solvency or liquidity. One thing is your ability to meet with your current obligations as a 4D. Another thing is to be able to meet with your long-term obligation or your future obligation as a 4D, which means as you are looking at meeting short-term, you are also preparing to meet up long-term. Short-term obligations are obligations relating to your payables. Long-term obligations are obligations relating to your debts, such as loans, such as bonds you issued, debenture, and the like. Therefore, we are also interested not just in today, because today will come and will go. We are also interested in the future, all because as a business, we are expected to continue to operate into the near future, which means as long as practicable, which then means that you must prepare for the future, and which is the case. Okay. The last one is more or less investors ratio, okay, or what we call capital market ratios. Investors ratios. You can also see it as capital market ratios. Some people might call it investment ratios. We are still saying the same thing. What matters is not the nomenclature. What matters is the understanding of the whole principle. Now, this is talking about from the angle of investor, rather than from the angle of management efficiency. Okay, how has the performance of this company or this business impacted the capital market or impacted the investors' expectations with respect to dividend, with respect to earnings, with respect to retention, payout ratio, coverages, and the like. All of these are things we are going to consider. And this also with respect to P, which is the fundamental of it all. And these are information, or what I call public information, that triggers market expectations and biases towards pricing securities in the capital markets. All of these ratios are things that we are going to take into consideration. Okay, in doing that, I'll switch back to my notes, where we'll look at these ratios in a granular basis. Now, within profitability ratio, as I've explained, there are various financial ratios or metrics that can be used to determine management performance with respect to profitability. One of the key ratios there is gross profit margin, or we'll call it gross profit percentage. Okay, what does that ratio measure? It simply measures the proportion of your gross profit. We all know what gross profit is. That is your revenue less your cost of sales. Whatever you get there is your gross profit, and you measure it as a ratio of your sales, which is your revenue for that matter. Now, whatever you get is your ratio, but the ratio means nothing if it can be benchmarked. For example, the only thing I can tell you, if there's no benchmark about the performance of a company that's turned out a gross profit margin of 20%, is to say the company has only made 20 kobo for every 1 naira revenue it generates. Yet it makes money, but it's still not sufficient for me to make decision. Now, to make decision means I must be able to benchmark it or compare it with something. And the question then is, what is that something I need to compare it with? And that is when we talk about benchmarks. Now, let me quickly take you back to my notes. When I say benchmark, to be able to make money of it, the first thing that is readily available to me as a benchmark is my comparison with historical performance, which means I compare myself with myself, but I compare my today with my past. I want to see the trend. Even if I'm not competing with anybody, I must at least compete with myself, which means, am I doing better than my past, or am I doing worse? Again, you don't deceive yourself by only comparing yourself with yourself, because what you believe you have done better than yesterday might still be a child's play. And in that scenario, you need to also look at who are your peers. Again, they must be comparable peers, not just picking somebody you are far above or somebody that is far above you. You must look at what is comparable based on the fact that you are more or less similar in nature. In that case, I'll also make comparison with my competitors. Let me put it as a clause, comparable competitors. It's not enough. I also want to look at it that, okay, where do I lie in the entire industry? Because not all your comparable competitors represent the industry. Usually, your comparable competitors is a subset of your industry, which then means that, okay, let me look at my performance against my industry. In that case, I can compare with my industry average. And therefore, what is an industry average? Industry average is just a simple average. Simple average means that you aggregate the performance of all entities, the ratios of all entities, and you divide them by the number of entities in that industry. Very straightforward. The question then is, you are looking at it that in the class, am I below average in my class, or am I above average in my class? Those are the things you also need to take into consideration. Sometimes you also take into consideration, depending on your growth trajectory, depending on your expectation to have a paradigm shift, you make comparison with set targets. I'll call it your set targets, which people call budgets. You say, okay, the board of the company or the executive management has budgeted that our return should be 15% this year. And it is based on other factors, starting from the overall strategic corporate objective. And they are saying that this is where we want to be. This is what we are thinking, regardless of what happens. Therefore, it's also a benchmark. Okay? It's similar to what you do in performance management, whereby you have standards, whether it's ideal standard, attainable standard, and the like, and you are trying to say, okay, regardless of it, this is what I'm looking up to. Can I get there? Okay. I think I'll just stop here. These are the fundamental ones that we can see as a benchmark that we can use. But there might be other benchmarks that you can also use in addition to this. But this more or less serve as a fundamental benchmarks that you use. Now, in that case, I'll go back to where I started from. Now, that is it. What that means that though I've determined that for every ₦1 sales, I made profit, gross profit of 20 kobo. But how good is that? It's for me to say last year, for every ₦1, I made 18 kobo, which means this year is better slightly. There's an improvement. Okay, but my competitor is making 25 kobo for every ₦1 revenue. The question then is, though I've improved against last year of myself, but I'm still lagging with my competitor. Therefore, you're already putting out insights, which is now left for users of financial report to make meaningful decisions. Now, you may not be interested in what form of decision they want to use it for, but you have your own responsibility with this ratio analysis or financial statement analysis is to draw up insights beyond just information. You know, you move from data, which is your raw transaction trial balance, to information, which is your financial statement. You are now moving away from financial statement, which is information, which is financial information, to insights. We'll call it business insights. And we use financial ratios as one of those tools for business insights. The other one we can also do is operating profit margin. What is the difference between that and gross profit is because gross profit only consider deduction of cost of sales, which is not the entire expenses. It's only a portion of the expenses. But operating profit will consider all other expenses other than finance cost and tax cost or tax body or tax charges. What that means that other administrative selling and distribution expenses incidental to me making sales. I also need to consider them. It is after you deduct those other operating expenses that you may come to arrive at operating profit. You're also now looking at it that from operating profit angle, am I doing better or doing worse? And what is the issue there? The issue there is that you might slightly perform better than last year. Let's go back to analysis we did. Last year, we made 18 kobo per ₦1 revenue. This year, we made 20 kobo per ₦1 revenue. They will clap for us, which means the clap will either go to commercial or marketing team, or because they are able to sell at probably higher price, or they are able to push more revenue, more product out. And two, to our procurement or buying unit, because they are probably able to take opportunity of economic of scale, whereby buying more because we're able to push more product to customer has reduced our cost of sales so that it boosts our gross profits. Okay, that's another angle. But again, we now need to look at other functional areas within the company. How have they even contributed to performance? By the time you get to operating profit margin, you discover that your margin last year was 10%, which means from 18 kobo gross margin, the operating margin last year was 10 kobo, which means 10 kobo profit for every 1 naira. But this year, we have 20 kobo for gross margin for every 1 naira. Unfortunately, we have 9 kobo for operating margin this year compared to 10 kobo last year. What is the problem? Let me show you so that I can visualize it, what the problem may be. We are still talking of company A and company what? B. Now, gross profits, margin, and operating profits. Last year it was 18. This year 20 kobo. This was 10 kobo. This year 9 kobo. Okay. Now look at what is happening. Sorry, this is not company and B. This is 2021 and this is 2022, the same company. X, Y, Z. Now, when you look at it, this year we're saying kudos. But this kudos is to who? Is to our marketing team, commercial team, and procurement team. Because one or combination of this factor contributed to this ability to buy cheap or take economic of scale in order to boost our margin, or ability to push more products through pricing and to increase our margin. I will give kudos to these guys. Now I'll put it in green. But some people have drawn us down, which means in this case, there's a question mark that why. I'll put it in red. Why? Which means if you check it, the 2 kobo gain here supposed to have at least bring about 2 kobo gain also here, which means if you go by this trajectory and keep all that in constant, this should be, as this is 10 kobo, this should be 12 kobo. But this is 9 kobo, which means we have lost 3 kobo in between this point and this point. The question is why? What is the why? If you remember from your financial statements, if your revenue is 100 and your cost of sales is 80, therefore your gross profit is 20. Now, remember you have OPEX. And you have operating profits. And this operating profit here is profit before interest and what? And tax. And this also, let's say, is tech. And at the end of the day, you have this. Okay, this was in 2021. In 2022, probably we made 105, or let me say 110, and this is 88. Okay. Let me just say 88. Yeah, let me just leave it like that. Let me put 86. And this is 15. Therefore, this is what you have. What that means that here you were happy, which is in green. But here you are unhappy, which is in red, because you are going down. And what has caused it is the OPEX. Now, when you delineate OPEX, let us break down our OPEX. If we break down our OPEX, what do we have? The most important thing there is payroll, or what we call salaries and wages, which is under admin. Under admin, you have things like rents and rates. You have motor running expenses. You have electricity and related expenses. What other expenses you could have? You could have promotional, okay, yeah, promotional expenses. And let me say others. Others. The question then is, last year, all of these expenses are 10, but this year, all those expenses are 15. Now, these expenses has grown in proportion higher than your growth in the gross margin, which then shows that between this and this, you have what we call expense to sales ratio, which shows that invariably, what has happened is that you have spent 8 kobo for every 1 naira sales you made, as compared to now you have spent 11 kobo for every 1 naira sales you made. In this case, this information will not drill down to say, okay, what mode of these expenses contributed to this? And you can find out that probably it's salaries, or probably is this. And in that case, you now have to trigger what we call cost control. This will triggers cost control and cost reduction, which you will have done in performance management. Which then means that in this case, the insights we have provided, which we are going to not only computing at this level, you now come back to say, okay, you've narrowed it down to expenses. Now those expenses, I'll also do relative analysis. What is the proportion of salaries and wages to my revenue? What is proportion of rent and rate to my revenue? That also will be visible to the eyes where the problem lies. And from there, you can be able to take control measures on them. Okay, and that is what we tend to achieve with that. Now, let's go back. We also have net profit margin. Now, for net profit margin, we are looking at net profit to sales. And what are you going to be looking at is that in this case, your net profit to sales is after you've taken charge of all other costs that are not captured as operating expense and are not captured as cost of sales. But what are these? These are interest expense, or what we call finance cost, and these are tax charges, or what you call income tax expense. Therefore, what will I do? I also come back here. Again, someone say I can't see the screen. I hope you guys can see the screen. I come back here again. I have net profits margin. Now, probably my net profit margin, I come to the 5, and here it is 6. Now the question is, hooray! This looked good relative to last year. Therefore, what has contributed to this is for me to investigate it. And I've said that 2 things will contribute to it. One is your interest burden, which is your interest costs. To sales. And also your tax burden, or your income tax expense to sales. Now, these two will account for this. And in doing so, let's say this might be -3, and this might be -2. And in this case, this might be -2. This might be -1. And therefore, what has happened? It means your treasury or your corporate finance unit might effectively have managed your financial leverage. Therefore, in this case, treasury stroke corporate finance stroke your ALM, asset liability management, might have done good job. Therefore, you give them kudos. Likewise, your tax units and management units or function may have equally contributed to this success. And in that case, you also look at it. How effectively have they managed the tax? Is it that they've taken advantage of tax incentive? Or they've more or less exploit the loopholes of the law in taking advantage through tax avoidance strategies? All of these things will be pointed out as a result of this analysis we've done. The way and manner we do this analysis are what we can find in the financial ratio. Therefore, we go back to our financial ratio. And as you have seen it, you must take care of it that it is not computing the ratios that matter, both in the exam and in the real life. Even when you read the examiner's comments they always tell you that, yes, people are able to compute the ratios, but they find it difficult to interpret and communicate the performance and provide advice to the management or to the stakeholder. And that is where the bulk of the work is, not in computation. Because computation is just, okay, gross profit over sales, yes, and then what? Operating margin, profit before interest and tax over sales, and then what? Everybody can cram formula and put it down, but the question is, if they give you a ratio question of 20 marks, your computation may not take you more than 5 marks, while 15 marks goes to interpretation and report writing. Which then means that of what benefit that you score 5, but in expressing what the result of these ratios are, in trying to make recommendation, you don't understand, therefore, what comes to bear. And that's why I'm taking you time to more or less bring this home in terms of a business insight and in terms of trying to conceptualize it and make meaningful recommendation to those that are affected by this performance. Any question at this point before I go further? Any question at this point? You can raise up your hand or you can send a chat. Any question at this point? Okay. From my screen here beside me, I can't see any answer or a chat. Okay, I think I'll move further. Now, I've discussed expense ratio, expense to sales. You can also look at expense to the total expenses, which means if total expense is 100%, what percentage of that 100% represents salaries and wages? What percentage of that represents rent and rates and the like? Now, another aspect you look at is asset turnover. Now, remember that the objective of asset is to draw up economic benefits. Now, the question then is, when we talk about economic benefits, we are talking about how will it generate revenue? Okay, revenue is a top line of economic benefit drawn to an entity. Okay, now the question then is, how best have we made use of our assets such that it's able to generate more revenue by way of turnover? Turnover means sequence or number of times we're able to replicate these activities towards increasing our revenue, which is our top line item in any organization. Now, we always look at the ratio from the perspective of sales or revenue as a ratio of your total what? Assets. The question is this: Company A made revenue of 50 million. Company B made revenue of 60 million. The question then is, which of the two management is efficient in utilization of an asset? I can't answer that question because you have only given me a variable which is equally absolute. Therefore, the next question I will ask you is simply, what was the assets that were employed to generate that revenue? If you give me that, I cannot compute relatively what the asset turnover is. And from there, I'm able to compare to say, the company that generated revenue of so much using these assets is more efficient in utilization of that asset than the other. And in that case, what happens? I'm able to make effective comparison. The same thing happens to return on capital employed, which was more or less like the first thing I used as an example. But in this case, the return, we cannot delineate it into various forms of capital. First, return on capital employed. Though there are different school of thought regarding definition of the metrics or variables that we use. But again, for this purpose, we'll say return on capital employed is a proportion your profit before interest and tax, which is known as earnings before interest and tax, bears with your capital employed. But the question is what is capital employed? Capital employed can be defined in 3 different ways, but it's not the definition that really matters. It is the consistency of this application across board that matters. What does that mean? My capital employed, for example, can be my total equity and non-current liabilities, which means it's the same thing as saying my non-current assets plus my working capital is my capital employed. That is a school of thought. Another school of thought says, no, it is my total assets, which means rather than considering non-current asset with working capital, and if you remember, working capital means current asset minus current liability. We are saying, no, take away current liability. Let us only restrict our capital definition here to total assets, which means my current assets plus my non-current assets, simple. And there's another school of thought that says, no, my capital in this case should be my net assets, which means my total equity. But there are arguments about it on the fact that the numerator may have excluded some other costs, such as interest costs and tax burden. Therefore, why then am I using net asset or total equity? But of the 3 methodologies, or school of thoughts, the first 2 are the most commonly used interchangeably. But as an analyst, you don't use them interchangeably. You stick to one, which is a philosophy of yours, and you constantly apply. Once you constantly apply it across board, you always arrive at the same decision. And that's why sometimes in ICANN exam, they will define to you what capital employed is. And where it is not defined, either of the school of thought as defined by you will be acceptable. But be careful, once it has been defined to you, you can't use any other one because examiner has told you what is capital employed is as at that point in time. But I'm standing in as the examiner here. My own philosophy or school of thought will take capital employed as total asset. That's why I said, for the purpose of our discussion here, I might see capital employed as total assets. Okay. Also, return on assets. Return on assets, you are looking at your residual return as a ratio of your total assets. What is your residual return? If you go back, your residual return is your net profit. And what is my net profit again? We'll come back here. You saw this analysis. My net profit is after I've deducted my interest cost and my tax cost from my operating profit, which means I can come here and say, less finance costs it will give me my profits before taxes. What you know as PBT. In that case, and therefore, what do I have here? Seven, and this. and less my income tax expenses. That's my profit after tax. Okay. Now, this is how we arrive at it. Now, I'm showing this to you because most times the examiner might switch question, whereby you might not have information directly, you need to walk back. For example, you needed your profit before interest and tax, but they gave you profit after tax, and you have information about your interest and tax. That means you have to add back those things to arrive at that, which means you have to have that understanding. Now, the question then is, my profit after tax is after I've deducted my interest expense and my tax expense from my operating profit, and I arrive at that. And that's what it means by that, which means if you go back and say, my return on total asset is a ratio of my profit after tax to my total asset. And in this case, total assets is very straightforward. There's no issue about it. It's non-current asset plus current assets. The final aspect of it all within profitability ratio is my return on equity. My return on equity means that I'm looking at it that rather than looking at return on all form of capital, I'm only restricting it to equity. And what is equity? Equity represents the residual interest in the net asset of an entity, which then means that equity is synonymous to net assets. And return on equity is the ratio of my profit after tax to my equity. And there's no problem about that. Okay? But where the issue might lie is that what if preferential capital is within equity? Okay? You then need to ask your question that, okay, if preferential capital is within equity, preferential capital and ordinary share capital are considered to be equity in that light, it then means I'll use my profit after tax to my equity, which is the total equity in that case, including preference shares. And otherwise, if preference shares is considered as a liability, remember, the preference dividend will have been deducted as finance costs before arriving as profit before tax and profit after tax. Therefore, equity will be restricted to ordinary share capital and the reserves. Okay, another philosophy is this. If I'm really looking at return on shareholders' fund, which means I want to restrict it to ordinary equity by way of knowing that in one breath, my preferential capital is still equity, but I'm looking at return not to preferential shareholder, but to ordinary shareholder. In that case, I can modify this return on equity by considering that my preferred dividend, I will deduct it from my profit after tax because that has not been taken care of. And my total equity, I will ensure I remove the component of preference share capital so that I know I'm speaking to shareholder, ordinary shareholders. That's why sometimes I can say return on shareholders fund, which might mean return on ordinary shareholders fund. But again, as I've said, what matters much more is your consistency in the application of those variables you have adopted in your metrics in this case. Now, in that light, we'll move to the next one. But before we move to the next one, there's what we call DuPont analysis. Okay, DuPont analysis is a further breakdown or delineation of the performance of these returns that we just discussed. Okay. Now, the point analysis. Now, recall one, return on assets. Let me see, recall first return on assets here. What's our ROA? Our ROA is profit before interest and tax divided by, that's profit after tax, right? Divided by total assets. And also recall our return on equity. Is our part divided by equity. Now, the point analysis means that I can further break it down. How do I further break it down? Return on assets. I can vividly tell you that return on assets is a function of two ratios. I don't know what's wrong with this pen. It's a function of two ratios. Asset turnover and net profit margin. Now, what is asset turnover? Asset turnover is the ratio of sales, if you remember our discussion, to our total assets. And what is our net profit margin? Our net profit margin is a combination of three factors. What are the three factors or three ratios? Profit margin, which is otherwise known as operating profit margin. Interest burden. And tax burden. If you remember this, remember this, or remember this, any of it. Okay, now, if you look at these ratios, what are we trying to achieve? We are trying to achieve that return on asset turnover is sales over total assets. I'll multiply it by net profit margin. And my net profit margin, remember, is from my operating profit margin, which is my operating profits, which I can call profit before interest and tax. I'll call it PBIT as a ratio of what? Sales. My interest burden is a profit before tax as a ratio of my profit before interest and tax. And my tax burden is a ratio of profit after tax over profit before tax. Now, if I go by this, it means all of these three ratios, I'll substitute them here. Profit margin, interest burden, and tax burden. And what then can I deduce here is that if you look at this, I can simply cancel this against this. I can cancel this against this. And I can cancel sales against this. At the end of the day, my return on asset is still coming back to profit after tax over total assets. And that's what we're trying to do. We are trying to delineate to say, okay, when you say your return asset is good, what makes it good may not be all of those variables. You might be doing poorly in asset turnover, but you are able to manage all of that as well. Or you can be doing more good in this, but you are not managing your interest burden well, or you are not managing your tax effectively, which means ability to draw insight from all of these will make you provide more clarity to the users and make recommendation. And that's what we are trying to achieve, not just computing the ratios. Now, let's now look at return on equity. If you recall, return on equity, we said it is profit after tax over equity. And we can delineate it as follows and say, okay, return on equity is first for a function of two things. Now it's the function of return on assets and a function of financial leverage. And the new concept I'm just bringing in is financial what? Leverage. And I'm going to discuss that. Now, again, remember, we're able to delineate this before now to say asset turnover and net profits margin. And we're able to delineate this further to say profit margin interest burden and tax burden. Now, if you could recall, the formula here is sales over total what? Assets. So give me 1 minute. Okay. That's total assets profit margin, profit before interest and tax over sales, interest burden, profit before tax over profit before interest and tax, tax burden, profit after tax over profit before tax. Now, what is new is the financial leverage. Okay, what is financial leverage in this case? The financial leverage in this case is the ratio of my total assets to my equity. And when we get to stability ratio, we'll understand it better that this ratio tends to measure the multiplier effect of your equity in financing your assets. Okay, what proportion of your total assets is financed by equity? And that is when you know how levered you are. When we talk about levered, we are talking about the proportion of the debt in your capital structure. And we're going to look at that when we get to stability ratios. Now, by doing so, what we are now trying to reach conclusion about is as follows: to say that return on equity is a function of asset turnover, a function of profit margin, a function of interest burden, a function of tax burden, and a function of financial leverage. I don't know what's wrong with the pen today. Okay, and if I'm to do that, asset turnover, sales over total assets, profit margin, interest burden, tax burden, financial leverage. Now, in this case, now you see how the delineation of this, which you call DuPont analysis, equally translate to a simple ratio of profit after tax over equity. And what is it? Sales, we cancel out sales. Profit before interest and tax, cancel out profit before interest and tax. Profit before tax, we cancel out profit before tax. And total asset, we cancel out total asset. What are we left with? We are left with the variable parts, and we are left with the variable what? Equity. And that's it. And you're going to see that when we are to interpret performance of a company by saying, though return on equity show we are doing well, but can you tell me which area are we doing well? Is it area of debt management? Is it area of management of operating expenses? Is it area of gross margin by way of profit, revenue? Is it area of asset utilization in generating more revenue? Is it area of interest? Or is it area of tax planning and management? All of these things are things we need to take into consideration. Not just ROE is 15%, the company is doing well. Yes, we know the company is doing well. What made the company do well? What made the company not doing well? What area do you believe we can develop on or improve upon? What strategy can we put in place to achieve our set target, given that we are lagging behind? All of these things are things that you need to bring into consideration when writing reports and communicating with the relevant stakeholders. Usually for this purpose, it's usually the board or the executive management. Okay, and that is that. Any questions so far? Any questions so far? Okay, if there's none, let's look at the second category. The second category are the liquidity ratios. Now, we'll look at about 3 of them. The first one is current ratio. Current ratio is looking at your ability to realize all of your current assets, all other things being equal, to settle all of your current liabilities as they fall due. Now, there is an assumption there that it may not take you sufficient time to realize all of your current assets in order to pay your current liabilities. But the reality of it is that sometimes you may not be able to realize all of your current assets as your current liability fall due. All of the critical things you might not be able to realize as a liability fall due is inventory. Because what is inventory? Inventory relates to the unsold goods that is within your custody. And how do you want to ensure that you sell those goods before your liability fall due and be able to collect those money to pay? The limitation there is that, one, you might find it difficult in certain period economic downturn to push more of your products, even when you do promotion, when you do discount, do all sorts of things, and people are not buying, most especially in the period of economic recession. And remember, your payable has a credit period which will fall due. And you don't want to default because it has consequence with respect to buying the loyalty of your suppliers. Because remember, from your CSME or from your business strategy, you'll have learned the 5 portal forces that serve as threat and opportunity to business within its business environment. And one of those factors is the threat of supplier. Okay? Or because you don't want to be stock out. Because stock out has negative beyond just losing profit for that period. You might also lose your own customer loyalty on the premise that most times when they come, you always give one excuse or the other of not having the stock. Therefore, that alone can change their behavioral pattern to buying things from you, or because they feel like, if I go to this person today, the person might tell me, they'll bring it tomorrow. Therefore, let me go to where I know, come rain, come sunshine, the product will be there. Which that means that there are many things you are trying to prevent as a result of stock out. And to avoid stock out is to be able to more or less marry and win the soul and heart of your supplier. And that is key. And to win the soul and heart of supplier, you must ensure that your supplier has confidence in you that you pay as at when due. Okay, that is that in that light. Now, what that means that current ratio may not be suitable at all times, or because of illiquidity position of inventory. And also not only inventory, there are some current assets that will never be realized in cash except in extreme situation. And these are prepayments. When you say prepayment, what it means is that you have prepaid for something you need to enjoy by way of good or by way of services, not by way of you getting money back. For example, if you are preparing for 2 years and you have consumed 1 year to go, you can't get it back in cash other than you take over the apartment and enjoy for another 1 year. And if you don't want to enjoy it, that's your own cup of tea. Which then means prepayment and some other nature of assets are things that are not cash in nature, and they will never be liquid because they only require you to consume them over time. Which then means that also, in addition to inventory, we need to back them out. If you are looking at something that is liquid in nature, sufficient enough for us to realize within a short period and make payments to our creditors. And therefore, we now want to do what we call a quick test ratio, or what we also call acid test ratio, which means back out those things that are not likely to be converted into cash in the immediate period, or the process of forcing them to convert to cash will result in a greater loss of value, as the case may be. And in that case, we always back out inventory and prepayments whenever we have them within our current assets. The next one is to the extreme level, which is not necessarily the case. We call it cash ratio. Cash ratio is like we are saying that no, we are only interested in cash equivalents, cash and cash equivalent, which means those things that are already in cash. It's just a matter of conversion. Which then means that what are we backing out in this case? We are backing out receivables. But people will be shocked. Why are you backing out receivables? Because we also know that even though receivables are guaranteed to be received in one way or the other, but there are limiting factors, especially in a period of economic crisis or some other factors that affect your debtors or your customers in paying you as at when due. And what you do is to seek redress. Which then means that seeking redress does not mean you get the cash. Is that you are trying to use the instrumentality of the law based on a contract or agreement between you to get your money back. But again, wait. I might be honest with you as a customer, but my condition is in a precarious state that I'm even in bankruptcy. What then do I do? Do you want my blood? It's a commercial transaction, it's not a criminal offense. Therefore, the worst is that you take me to court. The worst is that you get anything you can get from me. But what if everything I have has crumbled and you can't get it? I can't be jailed for it, except if there's an element of criminality or fraud. Do you understand? What that means that if I have no capacity and ability to pay, probably you take my blood, which is not possible. If you go by the Shakespeare, you can take your pound of flesh, but ensure that blood does not come out. And in that case, it becomes onerous for you to receiving or realizing your receivable in a condition of economic shock and some other factors. Which then means that there's also a possibility that your receivable might turn bad, especially in a period of contagious risk of multiple collapse based on one incident or the other, like what we are experiencing currently, which might likely trigger the next global collapse or global recession as a result of the Silicon Valley Bank collapse. As at this morning, I read over 168 banks across the world had one attachment or the other, and there might be contagious risk that will bring about run on those ones too, as a result of the CSB issue. Which that means that in that situation, a bank that collapsed and your customer's money is in that bank, how do you expect the customer to pay you? Therefore, all of those factors we might also take into consideration, but this is on a stress test basis, which means in an extreme situation, what then do? We can rely on cash ratio, which means you consider your cash and cash equivalent as a ratio of your current liabilities. And that is that. Okay, but what brings about liquidity or illiquidity is a function of how you manage your working capital. And the three critical variables in working capital are inventories, receivables, and payables. Let me take you through the working capital cycle. Now the cycle is like this. You have suppliers gradually seated. You approach them to buy goods. Or in some extreme situation, you approach them to buy raw what? Materials if you're a manufacturer. Now, naturally, sorry, I don't know what's wrong with this pen. Sorry, let me restart the pen. Okay. Okay. I'm identifying this pen. I don't know what's making it malfunction, but let me just try and still use it. Okay. That means from supplier to goods, which we call inventory, which you might call inventory. I think I know what to do. Suppliers. I have inventories, or let me say outputs. It can also come in form of raw materials if you have a manufacturer. And if it's raw material, I have to pass through other processes. I'll put them here. That's work in progress. What you call WIP. Before probably get to finish goods. But again, these other two processes that we identify here are not necessary if you are not a manufacturer. If you're a merchandise, you don't have those two. Okay. I think this is not check. Okay. Yeah. I'm not seeing this stuff I can use today. If I can use that, let me use the line. Okay, let me just use line instead of using curve. Okay, now from supplier to goods or raw material, from raw materials to work in process, from work in process to finished goods. Now from finished goods I'm trying to use this to do a cycle. to customers. Which otherwise you know as debtors. And from customers, to cash. And from cash, to suppliers, who are our creditors. So I'm unable to draw this circle in the way I will have done it. I don't know what's wrong with my pen today. But supply is also otherwise known as creditors. Okay. Or if you want to use the language of IFRS, you say trade payable. Here you say trade receivable. Now this is cycle, okay? Which means between this period to this period is the lead time. This period to this period is the lead time. Okay. This period to this period, yeah, it only affects production. This cycle, yeah, this period to this period is production cycle. This period to this period is the inventory holding days, or what we call inventory period. Okay, this period to this period is your credit period, which is also your receivable period. Now, the entire process of you collecting money, collecting goods from your customer, your supplier, up to this point where you have cash to pay back, is your payable period. Which means that your ability to manage each of this cycle well, your lead time, if you're in manufacturing, your production time, your inventory holding days, your credit period, and your payable period will result in liquidity, or otherwise illiquidity, as the case may be. Therefore, working capital management cycle is critical in the life of a business. Okay. Now, since I'm unable to use my pen well, I don't know what is wrong with the electronic pen. Let me try and Google out how it looks like for you. So that I can see the diagram carefully. Okay, let me switch to images. I'm looking for the one that is sweet. Okay. Okay, let's look at this first. This is one. You make purchases of raw materials, production process to customer, to collection of cash, and to your payable. Okay. I'm looking for one suitable like the one I've drawn. Okay, this is also similar to that. But again, you understand the concept of what I'm trying to point you out. Okay, this is also interesting. Other stock shelf. Other stock is lead period. Stock shelf is inventory holding days. This supplier pay period, overhead period, customer period. Okay. And which other one I can? As we all understood the concept carefully. Okay, I think something like this. Okay, this also looks interesting. Okay. You can see company purchase of materials on credit, buy. Goods are manufactured using raw materials. Company pay off debt suppliers, company sell off inventory, this and this. Now, if you look at this cycle means you are using more of your own cash because you are paying faster than you are even able to sell and collect. You know, it depends on the nature of the industry. That's why you can see that is where you have negative working capital, cash only business. You can also have positive depending on the situation. We're going to see it in all of our analysis where you want to determine your working capital cycle days. Is it negative, positive? Which one is better? And what condition comes into play with it? Okay, I think that is that. Now let's switch back to our ratio. Now, for the holding period, how do you compute it? You compute it as a ratio. That's your inventory turnover. Sorry, let me start with inventory turnover. Inventory turnover with a ratio of cost of goods sold, or what you call cost of sales, over average inventory. Now, for examination, when we talk about average, we are looking at opening plus closing divided by 2. But in reality, average inventory means what has been your inventory period over time, which in reality is not just opening and closing divided by 2. That will be determined by our inventory management system, where we can be able to track on an average daily basis what inventory level do we carry. We can easily average it over time. But for examination, you will not be privy to what the inventory holding period is every day, every week, every month. Therefore, what you are only provided as information is your closing stock last year and closing stock this year, and the average is just to add it and divide it by 2. Now, this ratio is telling you how many times are you able to turn over your inventory into revenue. The more you turn it over, the more efficient you are in management of your inventory, and the shorter your inventory holding period. What is inventory holding period? The period it takes you to collect inventory into your store and for you to sell to customers. Reciprocal of inventory turnover, the inverse of it is to determine your inventory holding period. What then do we do? Your inventory holding period or inventory turnover period is your average inventory, which means you flip it as a ratio of your cost of sales. And if you are computing in days, except otherwise stated, you assume 365 days a year. But sometimes examiner might tell you, assume 360 days. Whatever they tell you overrides whatever your understanding of the principles are. Also, account payable period, turnover, is you are looking at the ratio of your credit sales. No, sorry, account receivable turnover. You are looking at the ratio of your credit sales. Be careful, credit sales, not necessarily sales. But except otherwise stated by the examiner, you may assume that all sales are on credits, except if they provide you details that shows how to separate credit sales from cash sales. Otherwise, all sales will be deemed to be made on credit. The credit sales has a ratio of average account receivable. The number of times shows your ability to collect your money faster. The more your collection period turnover in times, the more ability of you collecting money from your customer, and the less the credit sales period or the credit period to your customer, which means it enhances your liquidity. Okay, account payable turnover is otherwise, like how often do you pay your suppliers? Less often means probably you are delaying the suppliers' money, and that might become a negative to you on the premise of gaining the suppliers' loyalty. And again, the more frequent you are able to pay connotes many things. One of it is that probably you are able to collect money faster and you are paying. And it could also connote that your inability to negotiate effectively with customers to be able to more or less pay at a later date in order to enhance your liquidity and put less of pressure on you. But again, it depends on all other factors that surrounds the situation at that point in time. And the average collection period, you reverse the position that the ratio of your average payable over your credit purchases times the number of days, if it's days, times the number of weeks, if it's weeks, to determine what is your average collection, average payment period for that purposes. Okay, these are the three categories of what we need to look at in our activity ratio: inventory, receivable, and payable. Inventory has two ratios in it. One is how many times are you able to turn over, and the other one is what is your inventory holding days. Receivable has two ratios also. What is your turnover with respect to collection, and what is your average credit period you give to your customer. And the third one is payable turnover, which means how many times are you able to pay your customer? What is the frequency? Okay, and the reverse of that is to know what is your average payment period available to you in order to meet your supplier's expectations. All of these are going to produce your effectiveness with respect to liquidity management. Okay, now we'll move further to the fourth category. The fourth category talks about long-term solvency and stability ratio. What does that mean? Remember, we started with liquidity, which means we are looking at our immediate obligation, which are obligation within an operating cycle or a period that is no more than 12 months from the reporting date. But again, you might have the ability to meet your current obligation as a 4G. But what about the bulk of obligation, which are more or less long-term? Are we able to do that? what strategy are we putting in place to ensure that as those obligations fall due in the future, we have the capability, the ability, and the cash to be able to repay. Therefore, we start to look at our long-term solvency ratios, starting from what we call proprietary ratio. Like in the exam, one of those ratios that they specify, if not the first, was proprietary. And one student told me after exam that that's the first time it seems to be hearing proprietary ratio, and I laughed. And luckily, because I'm the one that usually snap the board for you guys and share it by way of PDF, I went back to the class WhatsApp group and I picked the PDF of that day and I said, can you see? And later again, the person now confirmed to me that even in his own notes, he saw it there. And I said, this is the penalty for not always paying attention in class, because most times some people want to just write it. And I've said it severally that most things you write down, you might not have the opportunity of going back to them again, which means when you pay more attention, you might have grabbed some little things that even when you don't come across them again by you revising, you might still not forget them the way it's supposed to be. And that is proprietary ratio again. And this ratio is trying to measure what is of your total tangible assets, what portion of it can we say is financed by our equity. It's also a measure of gearing, okay? And in that case, we'll try to look at it in that perspective. To what extent can our shareholders fund or our total equity finance without debt the tangible asset we carry as an organization or a business? And again, I've told you, it says nothing, whatever ratio you can put, unless you benchmark it. And when you are benchmarking, you are asking yourself, if you are going higher, like it's increasing, is it a good thing or a bad thing? If it's decreasing, is it a good thing or a bad thing? Next, what brought about the increase? What brought about the decrease? And if it's good, what else do you do to enhance that beauty that it doesn't change? And if it is bad, what else do we need to improve upon to ensure that we turn it good? And those are the things we need to do. Secondly, we look at total debt to total asset ratio. In this case, you are looking at all of your liabilities, both current and non-current, and you are expressing that ratio to your total assets. If my total assets is 100 and the whole of my liability is 60, that means that I'm geared to the level of 60%. To say 60% of my total assets is financed by my obligations or liabilities. The other one is total debt to capital ratio. In this case, we are limiting it to long-term capital measures. What are long-term capital measures? Debts, that is things like loans, debenture, bonds that are of long term. They usually fall under non-current liabilities, plus any current portion of the debt that is more or less presented within current liabilities, just because of the requirement of IS1. And you also look at your equity, which then means that you are looking at what is the ratio of your debts, long-term debt, to the ratio of both the long-term debt and the total equity, which means long-term capital. That ratio is also measuring your level of gearing, but level of gearing relative to long-term capital, not relative to the total liabilities or total capital, as the case may be. Okay, another one we can look at is debt equity ratio. This particular ratio is much more important when it comes to capital structure and optimal capital mix, which means you are only restricting it to saying that, okay, instead of looking at the denominator to be long-term capital, let me only restrict it to long-term equity capital, which means what is the ratio of debts, long-term debt, to total equity. Now, let me show you what it means here from the exam so that you understand that we are saying the same thing with the first ratio. Now, if you come here, if you say company X, long-term debt and total long-term debt, let's say is 120, Total equity is 80. Therefore, the sum of these two is a long-term capital. Now we are now saying that first ratio says long-term debt as a ratio of total long-term capital. In this case, what you are saying is over long-term debt and total equity. Now, in this case, what is it? This is 120, and this is 200. Therefore, what is the ratio? In percentages, that's 60%. Now, 2 says debt to equity. Debt to equity is saying the same thing, but it's just trying to remove this. Well, that means that what you are saying is the same thing, 120, rather over 80. In that case, what do you have? 150, which means your debt is about 150% of your equity. While here, your debt is about 60% of your total capital. And that's what we are trying to say. Okay, and when you get to professional level, where you are doing strategic financial management, you will have understanding when you get to capital structure and optimal capital mix, that we'll be making use of this much more for capital market hypothesis and the like than this one. But again, there are still relationship of converting these two, which is what I'm just trying to show you. Okay. Now let's go back to our notes. Now also financial leverage. Now you can see it here, which I've explained earlier. Okay, we are looking at the number of times to which our total assets covers our equity, which is also a measure of stability. Okay, interest coverage is trying to say our operating profit, which is our profit for interest and tax. Peradventure in future, we have limited ability to make earnings. How many times can our current year operating profit or profit for interest and tax pay our interest expense in the foreseeable future, assuming the interest expense remain constant? And that's what we are trying to measure. How many times? Now let's go back to here, where we had small analysis here earlier. Look at it here. This is our operating profits or profit for interest and tax. You are not saying that, okay, what is the interest coverage? The interest coverage is not okay. How many times can you pay 3 out of 10? You now say 10 divided by 3. It's about 3 1/3 times. In the second year, it's about 4.5 times. Can you see that the reason why we said year 2 is better at our net profit position, because we are able to increase our efficiency, either by way of increasing our profit to cover more of our interest, or reduce our interest for profit to cover more of it in the future. And that is the position we have here. Okay. That is that here. Now, also, we'll go back. Fixed interest cover. This is like you are not limiting your interest just to borrowing cost, but you are also incorporating the effect of leases, that's finance lease, into it. Okay? But this is an extreme situation where you want to look at the entire finance charge, regardless of whether it's attributed to lease or not. But again, the same fundamental principle underlying. Also, dividend cover. Rather than interest here, you are looking at preferred dividend. This is fixed dividend cover. And this is always possible when you look at it to say, okay, I'm paying preferred dividend out of my profit. But why have the ability to continue to pay the dividend, given that future period, there's no sufficient profit? And how many times can I be able to pay that, assuming that such a dividend, such a preference share is cumulative preference share? And that will also tell me how many times. If my profit is 100 and my preference dividend is 10, it then means I can pay 10 times, all because 100 divided by 10 will give me 10 times. All of what I've just discussed further on stability ratios. The final ratio, before we go into practical demonstration of that understanding, are the investors or capital market ratio. The first one comes by way of earnings per share, but we'll see go deeply into earnings per share later. But in the surface, or on the surface, we are going to look at earnings per share from the perspective of profit after tax divided by the number of ordinary shares in issue, which later on we are going to qualify it as a weighted average number of shares outstanding. But for now, let's just see it from number of shares. And you're going to see the critical effect of the weighting when we get to IAS 33. But for now, just think at it as a basic level. Your profit after tax divided by your number of ordinary shares, provided there's no preference shares within your capital structure. And if there's preference shares within your equity capital structure, that means preference share exists and is treated as equity. It means such preference dividend has not been deducted from profit after tax. Therefore, what do? You deduct such preference dividend from profit after tax. If you remember what we discussed under IS1, whatever you get is not the residual profit only attributable to ordinary shareholder. You now divide it by the total number of ordinary shares. And again, what if it's a group? The group profit after tax is before your attribution of that profit to non-controlling interest, which that means you need to deduct the portion of non-controlling interest away from it. What is left is what belongs to the parent. And peradventure, if there are preference shareholders also, again, as we have discussed it earlier, you deduct it where necessary. But be careful, you don't deduct preference dividend if the preference share is treated as a liability. Why? Because the preference dividend will have been treated as a finance cost. And a finance cost will have been deducted in arriving at profit before tax, so that you don't double deduct preference dividend, except if you are told expressly that such deduction has been omitted or has not been treated in line with the requirement of IAS 32 and IAS 1. Okay, and that is it. When we get to IAS 32, you will have better understanding and appreciation of what constitutes preference shares, why preference shares serve as hybrid instruments, and at what point can it be considered as equity? At what point can it be considered as what? Liability. This we'll discuss when we get to IAS 32. And that is the position. Yeah. Now, thereafter, we'll move to dividend per share. What is dividend per share? What is the amount of dividend paid out in that year as a ratio of the number of shares? Now, be careful, dividend paid out. What simply means is that whether there's an interim dividend, which is dividend paid during the course of the year, and there's a final dividend paid as at the end of the year, whatever amount of dividend paid in a year will be aggregated together to form what we call gross dividend to ordinary shareholders. And that is what you are going to use as a numerator. And your denominator will be the same as what we have used on the basic level with earnings per share, which is the number of ordinary shares in issue, or sometimes you call it number of ordinary shares that are ranking for such dividend. We'll take note of that. I remember treasury shares does not benefit from dividend because we discussed within the conceptual framework what treasury shares are. These are shares of a company that is repurchased by that same company. And we've said that for accounting purposes, such shares will be deemed no longer to be outstanding, whether they are cancelled or not. You can refer back to all of our discussion within conceptual framework, including the video you can have on YouTube. Okay, now we also look at price earnings ratio. This is, if not the most important ratio within the capital market, P for short. Price earning ratio is a ratio of the market price of an entity as a ratio of the earnings of that entity. And you can calculate it at gross level, you can calculate it at net level. Gross level is to say what is the market value or market capitalization divided by the earnings, which is profit after tax. Or you calculate it at, usually it's calculated at the unit level. What is unit level? What is the market price per share? In the market, the price of GTB, let's say, is 25 naira per share. Now, what is earnings per share of GTB? Let's say it is 5 naira per share. It then means that the price earnings ratio of GTB or PE of GTB is 5.0. 5.0 means 5 times, which means its market capitalization can pay up its earnings for the next 5 years or 5 multiple times. And that's what it means. Okay, if you more or less inverse a P ratio, what you have is what called earnings yield. That means a reciprocal of a P ratio is earnings yield, which means be careful. An examiner knows you need P ratio for business valuation or for something, but an examiner will not give you P ratio, but will give you earnings yield. And it says your earnings yield is 20%. Therefore, how can I derive my P ratio from earnings yield since I know it is reciprocal or it's inversely related? The word inverse means 1 over that variable or that ratio, which means 1 divided by 20% is the same thing as 1 divided by 0.2, will give me 5 times, which is a P ratio, which means you must always understand relationship between financial variables, financial metrics, and financial ratios in order to solve business problems. Dividend yield is also looking at earnings, but from the perspective of payout. Remember, your total earnings does not translate to your payouts. Your payout plus your retention translates to your total earnings, which means the portion of your earnings payout in cash is what we know as dividend. The portion of it not payout in cash is also known as retention or retained earnings, as the case may be, which then means that dividend per share divided by market price per share will give you your earnings yield, which you need to take note of that. Okay, and likewise, you can calculate it on gross level, which means gross amount of dividend divided by market capitalization. You still get the same result, all other things being equal. You can also look at dividend payouts. What is dividend payouts? If you make profit of 10 million as a profit after tax, and they pay 4 million naira as dividend, it then means your payout is simply 4 million divided by 10 million, which means 40% of your earnings is paid out to you as dividend, while 60% is retained, which means retention is either 100% minus the payout ratio, or your retained earnings from the current year profit. What it means is that if current year profit is 100, you paid out 40, what you retain in that year to accumulate in your balance sheet is 60. That 60 is your retention divided by your total earnings, 100, will give you 60%. Which means instead of you computing 60 over 100 as 60%, I can simply say, since I know my payout is 40%, my retention will be 60% in order to make up total earnings of 100%. You need to understand all of this relationship. Similarly, the way we compute interest coverage or cover, the same way we compute fixed interest cover, the same way we compute dividend cover. When you get dividend cover, we are restricting it to ordinary dividend, which that means it is the proportion of your profit after tax, given that you have no preference shares, therefore no preference dividend, or you have preference share and you have deducted the preference dividend, the residual profit divided by the total amount of dividend you paid in that year will tell you how many times can you replicate such dividend with the current year income, all other things constant. And finally, net asset per share. Net asset per share is used to compare what the market is putting as a premium over your book value of the business worth. And what it simply means is this: if the market price is 20 naira per share, but the book value of the company, the net asset of it divided by the number of shares gives you 18 naira. It then means that the market is trading at a premium of 2 naira over the book value of that company. And also markets look at that in order to determine whether market is biased to the right or biased to the left in terms of overpricing or underpricing. But again, market pricing is based on many fundamentals, based on what we call market hypothesis or efficient market hypothesis, building in public information and information about future prospects and other events in extracting the potentials that the company has in the future. And that is what influences much of market price, which we call market information, okay, which might be totally divergent from the book value. Most companies trade at far premium from their book value. Again, there is also a shortcoming on the book value from our discussion on the historical cost financial statement, is that most of the book value are not reflection of current prices of assets and liabilities, because most of them are carried at historical cost, except for some companies that bulk of their assets might be carried at fair value, that you can see that the market sensitivity to pricing might not be far apart from the net asset basis of the valuation. But again, that is just the understanding at that. Now, before I move into to revise the base of comparison and the limitation of these ratios, the room is open for question. Any question? Someone asked for the notes. The note is in the group chat, and I can equally still send it again, or probably send it on this platform also. And also these work notes I'm working on too, I will likely share it to you guys. Okay. Any question? Okay, you said you have seen it. Thank you. Okay, somebody has sent the material back to the group. Thank you very much. Okay, any question? It seems you are not making this thing interesting. I'm the only one talking. I'm not even seeing most of your faces except for 1 or 2 persons. I'll see your beautiful faces. Okay. It seems there's no question. 2 things are possible. Okay, somebody want to ask question. Okay, I'll give you access. Can you raise up your hand and use the what's it called? The device to raise up your hand so that I can. Emisiano, I can't pronounce your name. Eme. Let me just say Eme. Okay. I've asked you to unmute. Okay, can you unmute yourself?
Yes, sir.
Okay.
Good afternoon, sir.
Afternoon.
My question is not, okay, let me ask, in the quick ratio, you said that want to calculate the quick ratio, you will remove the inventory from asset just to calculate the quick ratio. I'm saying in reality, if you want to turn to cash, if receivable and the inventory, I think inventory should be quick to convert to cash because it's still with you. It can, because if you are in a critical position, it can sell at discount and sell to person that are willing to buy cash. But receivable, you don't know the situation of the person having it. You don't know whether you have cash or the situation is into. But if you want to convert to cash, you can sell your inventory at the rate, at the lowest rate for you to get cash to solve your current problem. That's what I want to ask.
Okay. Now, your argument is assuming that you are in a cash-based environment. The first thing is that if you have been selling in cash, or you have the ability to sell in cash, you won't have even sold most of your products on credit. Do you get what I'm saying now? You are using benefit of eyesight now to say, okay, I want to collect cash only now. No. The question is, the nature of your business, is it cash-based? If it's cash-based, therefore, why then sell before on credit? And if it's not cash-based, that means that inventory. Okay, have you seen a situation that you give discount of 40% and people are still not buying because there's no money to buy? You didn't get it.
I get you, I get it.
Receivable is easier to convert to cash than inventory because if people say we are not buying, they are not buying, what will you do? Your goods might perish at the end of the day.
Okay.
Even when you give discount at some point in time, people will say there's no money. In the period of recession, as I've given you an example, or period of economic retardation, what do you expect? Everybody hold on to things. You only buy essential things. And you don't buy to store because you don't know what the future holds. Do you get what I'm saying? That with them is inventory. It's more, it takes more time to convert to cash than receivables. Remember, your receivables, you have other things that can make it easily converted. Because you don't just sell to anybody you want to sell to on credit. You sell to those that have the ability, the capacity, and other things. You remember your 5 to 7 C's, principle of credit analysis. Therefore, it is very rare to find your inventory easy to convert than your receivables.
Okay, sir.
Yeah. Okay. Somebody's asking a question. Well, we'll take a break. We'll take a break once we finish this analysis, but before we solve problem. We are already too straight. Femi, over to you.
Hello, good afternoon, sir.
Afternoon, sir.
Okay. I must say, I love the way you have delineated this ratio analysis so far, and it gives an insight into how analysis of financial statement can be done very well and in a more practical way. Okay, my question here is, in analyzing financial statements, talking about the balance sheet, the income statement especially, is it better to analyze, talking about benchmarking based on the company's previous activities and all, is it better to use the previous month's activity or compare with budget? For example, if budget for the year has been done and you have look at operating expenses to be like, say, 500 million, for example, and you are doing lesser, sometimes you can do better than the previous activity, but less than budget. So how would you rate the situation? If you are doing better than previous months or previous years, but less than budget. If you have budgeted 500 million in terms of costs, you are doing lesser costs this month, but previous months you are doing higher costs. Would that comparison be better? In terms of revenue, if what you have budgeted for that period, what you have realized in the current period is less than what you have budgeted, yet higher than previous period. So which is the better comparison? That's my question.
Okay. Yes, you can remember that when I started, I said, benchmark. You benchmark with yourself, at least it's readily available information. You benchmark with your peers. You benchmark with industry average, and you benchmark with your set target, which is your budget, like in this case. The question is that you don't just pick one benchmark and say it's okay. You look at it holistically. Now, as you have done in this case, the scenario you portrayed. Now, first, ratio analysis for these purposes, we are doing it for financial reporting purposes, not for management reporting, which means management reporting, monthly reporting, and co. No, our own focus is financial reporting, and the minimum reporting period is interim, which is usually quarterly. Okay, and the normal reporting is annual, which is yearly. Therefore, we must restrict it to that first, but the principle remains the same. Now, when you are benchmarked against your past and it is good, but the good is not good enough for the set target, the question then is, management will now look at it that, okay, this target itself, is it even realistic? You know, when you look at standard costing, they'll tell you we have ideal standards, we have realistic, which is attainable standard, and the likes. Probably you have set an ideal standard, and you know what they call ideal standard in a real sense? They are unattainable standard. Standard that is stretched too long, that is either you reach it and you collapse, or you try reaching it and you lose your focus. What that means that might be a trigger for the board or management to say, no, we are unnecessarily stretching what is not practicable. For example, we are given a standard that revenue should be so much, but you fail to even conduct analysis regarding aggregate demand. Because if the entire market in which you operate can only demand 10 million units of an item, you have about 10 players in that market, and before now you are sharing about 5% market share. 5% of 10 million is expected to be like 500,000 units that you can push to that market. But without considering aggregate demand in next year, your management said you want to do 10%, or you want to do, let me say, you want to move from 500,000 to 600,000. But they fail to understand that even the aggregate demand by way of forecast and macroeconomic estimation for next year, that 5 million will even drop to 4 million, which means you are not looking at a whole externality factor. You are only looking at just pushing numbers. And that speaks to budgeting. Some people just say roll over the budget, flex it, without even looking at economic underlying. And therefore, that might now call management to caution to say, no, budgeting or setting targets is not just desire. It's not just emotion. It's something that is backed with macroeconomic and microeconomic indices. Do you get that? And in that case, you say, no, these guys are trying, but probably the standard we are setting is not ideal. Or it might be ideal that there are still areas to which they have shortcomings. And that's why in analyzing performance, you don't analyze just based on a benchmark. It's based on multiplicity and the combination of those benchmarks. Do you get that? And remember, everything is still based on your expectation and your judgment. And that is just it. I think I've answered that your question. Okay, if there's no other question, now let's quickly wrap it up again to refresh our memory on the benchmarks. Okay, remember I've said industry standard, comparable companies. Intra-company means comparing with yourself in the past. Reasonable judgments, management judgment, target, and all sorts of things, and that's what you have. But let me quickly take you back to limitations of this ratio. Everything has its own pros and cons. And one of the critical limitations of this ratio is that it's still based primarily on historical data, which then means that the same limitation that affect financial statements itself will see affect ratio on the basis of historical data. Okay, and ratio find it difficult to analyze qualitative data. Your performance or non-performance is also influenced by qualitative data that you may find difficult to quantify by ratio analysis. Therefore, it means ratio analysis assumes all of that things are constant, especially qualitative. What if those things are not constant? How do you now fuse it in your own analysis? And that's why your business insight, your understanding of what is going on will also come to play in your report writing. Okay. Also, some ratios does not have universally accepted parameters or definition. What I've told you how to mitigate against that is that once you constantly apply the parameter across board, your decision will always be the same. Okay. Now, ratio itself, if you go by ratio, it will not address differences in accounting policies or differences in gaps. When I say gaps, GAAP, generally accepted accounting principles and practices. Which that means that before you compute ratios, you must first of all ensure that the accounting policies of the companies are alike. And if they are not alike, what then do? You try to adjust the policy of one to the other. And by doing so, you will now have to compute ratio thereafter. But if you just compute ratio without taking cognizance of differences in the policy, your interpretation or results might be misleading, which is a mistake many people make. And that's why in exam, except otherwise stated, you probably assume that the account policy are the same. But if you see some exam, they will now tell you that the accounting policy of company A for PPE is revaluation model, while for company B is cost model. Therefore, you have to adjust one for one before you can make comparison by way of ratio analysis. All of these things are what you need to take into consideration in addressing the limitations. Now, if there's no other question for now, we will go on a short break and return by 12:30. Thank you very much. Okay, well, welcome back. Now we'll look at a problem and we'll try to discuss this problem. And we'll try to provide solution to the problem. This is one of the ICANN past question, I think, November 2016. Okay, this question was examined, and let's look at it with respect to all of our discussions. Okay, who will volunteer to read? Is our class reader, is she available? If she's available, can you signify by raise up of hand so that I can give you access to unmute? I can't see a hand. Probably she's not in yet. No, I think I can see her name. Okwemi Adeoye, I guess that's the person. I know it's Okwemi, but I don't know the surname. I can see surname here. The only Okwemi I can see is Adeoye. Okay, Okwemi Adeoye, can you unmute?
Good afternoon, sir.
Good afternoon. Are you trying to hide yourself before?
No, I wasn't, sir. I wasn't.
Okay. Can you read for us now? Thank you.
All right, sir. So question
3, yeah.
Question 3. Sorry, sir. I'm trying to.
Are you using your phone or you are using a laptop?
I'm actually using my laptop.
Therefore, can't you see it? I think I've displayed the question.
It's not bold enough, so I'm trying to open it here.
Okay.
Page 6. I'm sorry, sir. I don't know if you can help me to zoom in a bit to the question.
Okay. Because before I wanted to display it in such a way that you can see it at a glance, but since, okay, over to you.
Okay. Magilaria PLC have been trading in merchandise for several years in Golden City. The information below relates to extracts from the financial statements for the past 2 years.
You can continue.
Okay, sir.
I say you can continue. Hello? Okay, can somebody else read? It seems we've lost her on the network. Who will volunteer? Can you raise up your hand, please? Okay, Aziz.
Can you hear me, sir?
Yes, I can.
Magifera PLC had been trading in merchandise for several years in Garden City. The information below relates to extract from the financial statements for the past 2 years. Statement of profit or loss and other comprehensive income for the year ended September 30.
Okay, you can call the items in the account, but not the figures.
Okay. Now, 2016, 2015, revenue, gross profit, administrative expenses. Next, sir. Okay. Finance cost, 10% loan, not 10% loan, not interest. Operating profit before tax, less taxation expense. Operating profit for the year, dividends paid to equity holders. Extract of statement of financial position as at September 30. Asset, non-current asset at cost, less accumulated depreciation, carrying amount, then current asset, inventory, trade receivables, bank balance, total asset, equity and liabilities, ordinary share capital at 50 kobo each, retained earnings, 10% loan notes, 10% redeemable preference shares. Under current liabilities, we have trade payables, taxations, bank overdraft, then total equity and liabilities. The board of directors were worried over the winding financial performance and precarious financial position of the company. The products are aging. The economic depression is beaten as a result of the worsening exchange rate of $1 to 400 naira. The company imports 60% of the goods sold in Garden City. The worsening exchange rate had affected the company's importation. Consequently, the revenue of the company dropped significantly. The unsafe financial performance has also affected the market. Next, sir. The market price of the company's shares, which dropped from 12 kobo per share in the year ended September 30, 2015 to 8 kobo per share in 2016. You are required to calculate the following ratios for the year ended September 30, 2015 and 2016 in columnar form. Roman figure 1, return on capital employed. Roman figure 2, total assets turnover. Roman figure 3, quick ratio. Roman figure 5, Roman figure 4, beg your pardon, debt equity ratio. Roman figure 5, fixed interest cover. Roman figure 6, earnings yield. Roman figure 7, price earnings ratio. Roman figure 8, dividend yield. Part B, write a brief and formal technical report to the board of directors to assess the performance, liquidity and stability of the company using the following. Using only rather, return on capital employed, total assets turnover, quick ratio, fixed interest cover, debt equity ratio. Hint, brevity, technical, and formal report presentation are essential and will be rewarded.
Okay. Thank you very much. Now, since you guys have the question with you also, you can put the question by the side as you look at what we wanted to do. Now, take note of the ratios. We are told to do return on capital employed, total asset turnover, quick ratio, debt equity ratio, fixed interest cover, earnings yield, price earnings ratio, and dividend yield. Okay, now there's no information that requires adjustment to these accounts. You have to be watchful of that because you might still need to adjust the account before computing ratios. But the only information they gave us here are information that border on economic activity, macroeconomic issues, such as deterioration or depreciation in foreign exchange rates, and also issue of economic depression, issue of imports, the effect on the importation, because 60% of our goods are imported and foreign exchange is moving against us, it's also likely going to affect our profitability, okay, and our sales, as the case may be. All of these things are what we also need to take into consideration as an insight towards making recommendation to the respective parties. Now let's look at what I did. My suggested solution is this. We'll look at it one by one. Now we have to compute return on capital employed. Okay, as we have said earlier, we have various school of thoughts, and I adopted the two that is most paramount, so that either of the answers will be correct. What matter is your interpretation will go in the same manner. Okay, now what does return on capital employed shows? Okay, what it shows is very simple, is that it shows our return with respect to what form of capital in the business we've put into place. Okay, and it reviews the efficiency of management in the utilization of the resources employed. And if you look at this ratio, we have to more or less determine it based on the proportion of profit before interest and tax to capital employed. But we have no problem about our numerator, but we have a problem about denominator, all because there are about 2 to 3 parameters for denominator. Now, since I'm only providing answer to you as students, I am looking at all possible solutions, which means where return on capital employed is my total equity and non-current liability, and where my capital employed is my total assets. Okay, as the case may be, in either of the position, we can see what it is. Now, what is the numerator? You find out that we are carrying out an operation in the numerator. Why are we doing that? Because when you go back to our account, what was given to us, let me go back to the account. Our income statement. You find out that what they gave us here was profit before tax, okay? But we needed profit before interest and tax, okay? And they didn't give us that. What then do? We added back the interest to our profit before tax. And that is what we tried to do for both 2016 and 2015, okay? Take note of that. Which means I've told you earlier, you need to understand relationships so that you can be able to find information that are hidden. Sometimes they can give information the way it is. Sometimes they might give you in the way you have to derive them. And that is the first one. Second one is that our first approach is to say our capital employed is total equity plus non-current liability. And if we go by that approach, we have these two denominators. But if we go by the second approach of total asset, we have these two denominators. What matters is the direction that both in the first methodology and the second one, we have our return on capital employed higher in 2015, last year than this year, which means the effect of this economic depression and some other accompanying factors are starting to affect us. You could see that our result is close to like being halved in both instances. And that is the point we are able to draw out of this, that our performance has reduced close to about 40% or more. But again, what brought about that, we are going to look at it as we move forward. The other one is about the asset turnover. As I said earlier, asset turnover also borders on examining how you have been able to make judicious use of your assets to making sales. Now, remember, if you go back to our question, our revenue for 2016 is 100 million and 2015 is 160 million, which means our revenue dropped by 60 million. Whereas we've already invested humongously in assets, even though it drops at the end of the year from 107,500 to 96,500. But the drop in assets does not commensurate with the significant drop in revenue, which then means that our asset turnover will probably produce a ratio that we need to interpret. Now, what is the interpretation of this ratio? You find out that our asset turnover in 2016 seems to be slightly higher, but marginally, compared to 2015. And in 2015 is approximately a time, which is 0.97 times. And in 2016 is approximately about 1.04 times. And the question then is, yes, it seems we are slightly able to be efficient, but that efficiency has not made any difference in asset utilization. Okay, we also look at quick ratio. Quick ratio in this case, the only thing we have to take out there is inventory. We don't have prepayments. If you go back to our balance sheets, you can see that it's only inventory that is a component of current assets that we need to take out, okay, from our analysis of quick ratio or asset test. And in that case, taking that out, we are left with this other two, that is trade receivable and bank, okay? And we are also left with the entire of current liability, which seems to be higher than what is left. And if you go by that, what then do you see? You find out that as compared to last year, we are highly liquid with 0.71 to 1 than this year, which is 0.55. And what you can deduce is that more of our, if I'm looking at it, more of our assets are held in inventory. If you look at the balance sheet again, relatively to last year, our inventory level was only 7.5. This year is 32.5, which shows humongous inventory, which means what went wrong in our inventory management for this year. And probably we never emphasized enough that there will be global or economic depression as signified. And we have already held bulk of our goods in inventory by our projection, which are unable to turn into revenue. And that may have accounted for that shortfall in our liquidity ratio. Okay. Also, debt equity ratio, remember, we look at our debts as a ratio of our total equity. Remember, there are two perspectives to it. Are you looking at total capital or are you looking at total equity alone? Now, let's go back to the balance sheet and look at what is our debt and what is our equity within the structure. From the balance sheet, you can see that our debt this year is just 12.5, which is loan notes. Last year is about 12.5, and if you consider redeemable preference share as debt, it will be 14.5. Okay, now our equity is 23,017,200 and 23,000 and 10,000, which means we are looking at our total equity alone. We are not looking at long-term capital in totality. Therefore, this will have given us, for 2016, it will have given us 40,200, and 2015, it will have given us 33,000. And I think that is what we have there in our analysis here. to show what we have here, and that is it. And in this year, we have low gearing, which is something good for us compared to last year, which means we have been able to more or less either reduce our obligation. The only obligation we have reduced here is the preference shares that we have redeemed, which is no longer there. And secondly, we have been able to improve in our performance by making more profit to boost our equity, and that also contributed, which means two factors contributed to this reduction in our level of debt or gearing. One, we are able to successfully redeem our preference shares, and two, we are able to make good performance to at least increase our retained earnings from 10,000 to 17,200 as a result of profit for the year. Now, the other one is fixed interest cover. Now, the fixed interest cover is looking at our profit before interest and tax as a ratio of our interest. And if you go back to our accounts, what can you deduce in the account? In our income statement, we are not giving profit before interest and tax. We are only giving profit before tax. And as I've said earlier, by the time we add back our finance costs, we are able to get profit before interest and tax. And we are going to do it as a ratio of this fixed interest. And by the time you look at that, what we came to conclusion is that in the current year, we are barely able to pay 18 times of our interest compared to 34 times, which shows poor performance because our profitability dropped significantly between 2015 to 2016, and that is unconnected with the economic depression as identified as additional information. Okay, any yield, as you earlier said, we can calculate it whether in unit form or in gross form. But the information we have here is more or less in gross form. Okay, what is it? We have our earnings, and our earnings in this case is our profit after tax. Okay, if you go by way of our profits after tax, which is what you can see in the question. Let me go back to the question as I'm switching. In the question, you can see that we have earnings after tax, which is 13,250 in 2016 and 25,250 in 2015. Okay, 2016 is lower. Now, but we are given the market price. Okay, what's our market price? Are we given the market price? Yes, we are given the market price. Okay, if you remember, the market price of the company share would drop from 12 kobo. 12 kobo was in 2015 and it dropped into 8 kobo. Now, and how do we know the number of shares? Remember what I always say in class. See, this is 23 billion naira capital, but take note here, the nominal price is 50 kobo, which means how many shares times 50 kobo will give us this amount is for you to carry out this operation that we have done severally in class. And what is the operation? The operation is that the number of shares is to divide your share capital by the nominal price, which gives us 46 million shares. Now 46 million shares multiplied by 8 kobo in 2016 will give you the capitalization in 2016. And 12 kobo multiplied by 46 million in 2015 will give you that. And invariably, our PE is about 360% and 457%, which is equivalent of 3.6 and 4.6 respectively times, if you want to convert it to times. Okay, and which means our valuation last year is higher than our company valuation this year, as the case may be, from the market perspective. Okay, which means the market has also responded negatively to our poor performance. And that is what we have seen here. And also the poor performance for now, we are more or less putting it on the doorstep of the economic depression that we are told has happened. Okay, now price earnings ratio That's the yield. Price earnings ratio is a reciprocal, is a reverse of it. Reversing that shows that rather than have your market price or market valuation as a denominator, we now have it as the numerator, okay? And the other one as the denominator. But again, I can also do it as 1 divided by 360%. It will still give you 0.28 if you have to go through a fast route. And 1 divided by 457% will also give you about 0.22, which shows that though our P ratio is higher, but our earnings yield is lower, which means they are inversely related, all because the higher the market price, the lower the earnings yield. And the lower the earnings yield, the higher the market relative valuation, all because if this lower value, if this earnings per share, which is the denominator, is low, and the market price is high, it's going to increase our P. And conversely, if the market price is low and the earnings is high, it's going to more or less reduce our P. And that's always is used to determine sometimes in the capital market what we call value stock and growth stock. Okay, value stock usually have higher P, lower P, while growth stock always have higher P. And probably when you get to strategic financial management, you understand the market bias towards such. And mostly in global world today, you'll find out that most technological companies, especially fintech in today's world, are growth stock. While some companies are already matured that they are value stock, such as the Microsoft, such as the Meta, former Facebook, Google, and the like. Okay. Dividend yield. Dividend yield is the ratio of your dividend per share to your market price per share. Or if you are to do it in total value, it's going to be the ratio of your gross dividend to your market capitalization, which in this case we use the gross. The amount of dividends that was, if you go back to the question, the dividend that was paid in the year was 6050 compared to last year 8550. Okay, and we're going to compare that with our market capitalization, which you already have before. And if you compare that with the market capitalization, remember 8 kobo and 12 kobo, we have 164% and 154%, which means even though there is poor performance here, because the numerator is more or less, the proportion of reduction in numerator is not more than the proportion of reduction in the denominator. In that case, the decrease in market capitalization is higher in proportion than decrease in the amount of dividend paid, which now still make our dividend yield in the current year higher slightly or marginally than the prior year. Okay, these are all the ratios that I think we are told to compute. Now, the second aspect of the question borders on, from the little understanding we have in this question, plus the microeconomic objective and issue that are given to us as additional information, we are told to do something. What was it? Let's go back to the question. We're told that write a brief and formal technical report to the board of directors to assess performance. And when we're assessing performance, the only ratio for performance here is return on capital employed. To assess liquidity, the ratio for liquidity falls between quick ratio and asset turnover. Okay, now just quick ratio. Asset turnover, I can still take it much more along with stability ratio, which means stability will be asset turnover, fixed interest coverage, and debt equity ratio. Therefore, what will be our position? Remember this requirement. The hint by the examiner is to tell you that you are not just to write stories. You just need to go straight to the point, given that you have understanding of the problem and you know what kind of recommendation you can give where required. Now, if you go by that, I want somebody to read this on our behalf so that I will explain. Who will volunteer to read at this point? Okay, Ali, over to you. Okay, Precious.
Okay, so I should read the internal memo.
Yes, that's report. You use internal memorandum to write reports within an organization, especially when you are writing to authorities. Okay, you are the chief finance officer in this case, and you are writing to the board of directors, reflecting on the financial and performance measurement for 2016 relative to 2015. Okay, over to you.
Okay. Above subject refers, I write to present the analysis of financial performance, liquidity and stability of the company for the financial years ended 30th September 2016. The financial year ended 30th September 2016 is a challenging year that have experienced an unprecedented economic challenges ranging from foreign exchange scarcity, volatilities, and incessant policies of the Central Bank of Nigeria, which have worsened the economic condition of the country and also equally made economic to enter recession by the end of Q2 of the year. In the advent of the economic challenges and of its contagious effects, our company has continued to strive amidst those challenges. I have analyzed the financial results of the company with the financial ratios that assessed the profitability, liquidity, and stability of the company's operation in 2016 as compared to 2015. The outcome of the financial analysis and financial review revealed the following. Profitability. The profitability measures and that of the measurement of return revealed a deterioration in the operating performance for the year, as the return on capital employed indicated a lower measure of 42.69% or 23.32% in 2016 compared to 89.47% or 39.53% in 2015. The poor operating performance was evidenced even when assets turnover experienced a marginal increase with a ratio of 1.04 times in 2016 compared to 0.97 times in 2015. Liquidity, a measure of short-term solvency, was adopted in the measure of the liquidity and ability of the company to meet its current obligation as they fall due. The liquidity measure via quick or acid test ratio showed a drastic reduction, 0.55 in 2016 as compared to 0.71 in 2015. In the liquidity position of the company with respect to the amount of its cash and cash equivalents that are available to meeting its current obligation payable not later than operating cycle or the next 12 months. Stability. A gearing ratio of the company has reduced during the financial year under review, and it signifies low financial leverage of the company. In 2016, the debt equity ratio was 31.09% compared to 43.94%. This shows a better position for the company in its ability to meet long-term obligations as they fall due. Conversely, the observed dismal financial status of the company is evidenced by the interest coverage of 18 times in 2016 as compared to 34 times in 2015. This represents a significant deterioration in the ability of the company's operation to be able to finance its interest payments over a long time period a long period of time when compared to the prior year performance. Conclusion and recommendation. The overall financial review depicts a non-favorable overall performance as compared with the financial results of 2015, and in the light of current economic strain and condition, a revamping strategy is required to be instituted by the management and board of the company, which may include important substitution, hedging the company's
import
substitution, hedging the company's currency exposure, alternative source of supply, in bracket, raw material substitution with local produce, pruning of costs, etc.
Thank you very much. Now, you could see the conclusion, apart from your demonstration of understanding with these narratives here, your conclusions speak more volume that you are a problem solver based on the insight you have. You don't need to write 3-4 pages before you drop insight. You could see that because we already acknowledge that there's a depression within our economy, therefore that is beyond our doing. Therefore, what then can we do in the midst of this depression? What can we do to remain sustainable? Is that one, we discovered that 60% of our costs of our goods are imported, which then means that can we go by way of import substitution? Are there alternatives to importation whereby we can source practically all of our goods within Nigeria? Two, if that is not possible, or we can do that but not to 100%, the little we will still import, how do we hedge against foreign volatility and exposures, which means hedging is also being recommended. Alternatively, within our local space, since we want to prune our costs, can we look for material substitution? Can we look for other suppliers? Can we look for how can we just try to ensure that bulk of our cost of goods are reduced in order to ensure that at least we remain sustainable by way of earning sufficient margin or earnings from our dealings? These are just the little idea that you can be able to put together. Okay, let me check, because most times, okay, depending, I don't know the report, I can adopt it, because most times if I prepare such solutions, okay, yeah, I think they adopted the whole of my solutions because exactly all of this analysis I did, except that they didn't pick all this narration. They are not necessary. This is just for you to understand, but they pick all what I've done here. Exactly all what I've done here is what they picked. And I think they picked my internal memo. But they did additional ratios because, okay, I don't think they did additional ratios, it's the same thing. Now, the same thing we have here is more or less what they have. We have similar things, the same stability and other things, okay? But their conclusion is just short. That in conclusion, performance and liquidity deteriorate from this, but I expect, probably because they didn't say they should recommend, but here is conclusion and recommendation, okay, which shows much more elaborate stuff. Let me show you ICANN solution. I thought I was showing you before. This ICANN solution, you can see that, okay. Okay, but that is that for that. Let's also now look at another year. Let's look at another year, this 2016. Now let me open question for another year. Let's look at 2014. I found 2014 question also interesting. let's use it to also buttress, or 2014 might be too far. Let me check whether I can use 2017. There's also 2017 question. Is there no, okay, I think there's no ratio in 2017. There's no ratio in 2017, therefore I'll use 2014. Okay. Okay, 2014, that's question 2. This is question 2. Okay. Okay. Who will volunteer to read this? Raphael.
Question 2. A non-accountant friend of yours attended a seminar for non-accounting executives on interpretation of financial statements. Though he enjoyed the seminar, especially the aspects on the uses of accounting ratios, he strongly believes that they have their limitations. State and explain the limitations of ratios for the purpose of interpreting financial statements. B, you are provided with the following set of amended published financial statements of Atman PLC for the year ended 31st December 2013. Consolidated statement of profit or loss and other comprehensive income. We have 2013 and 2012. So revenue is 257,520 in 2013, then 2012 is 254,444. Cost of sales is on credits of 126,796, and then 2012 is 127,458. Gross profit is 130,724. Then in 2012 is 126,986. Then we have net operating expenses of 9,710 in 2013, then 9,578 in 2012. Then we have net finance income. Hello, sir, are you with me?
Yes.
Okay, net finance income of 1948 in 2013 and 1316 in 2012. Net profit before tax, we have 34,762 in 2013 and 32,574 in 2012. Income tax expense, we have 10,256 in 2013 and 9,170 in 2012. Then profit for the periods, we have 24,506 in 2013 and 23,404 in 2012. Dividend per share paid is 58.50 kobo in 2013 and 52.50 kobo in 2012. Total dividend paid in thousands is 11,256 naira, and then 10,216 in 2012. The dividend per share proposed is 44 kobo in 2013 and 39 kobo in 2012. Total dividend proposed in thousand naira is 8,564 in 2013, then 7,590 in 2012. Consolidated, okay. Consolidated statement of financial position. Non-current assets, we have PPE in 2013 was 69,864. And then in 2012, we have 74,630. Motor vehicles, we have 11,554 in 2013, and then 11,200 in 2012. Current assets, we have inventories of 16,548 in 2013, and then 18,344 in 2012. Trade and other receivables, 59,092 naira in 2013, and then 41,982 in 2012. Cash at bank, we have 62,824 in 2013, then 69,916 in 2012. Assets classified as held for sale, we have 1,874 naira in 2013 and nothing for 2012. Then total assets is summed at 221,756 in 2013, and then 216,072 in 2012. Current liabilities, 48,019 naira in 2013, and then 49,042 in 2012. Non-current liabilities, 43,778, then 45,276 for 2012. Capital reserves attributable to equity shareholders. Next page, sir. Called up per share capital is 9,730 in 2013 and 9,730 in 2012. Share premium account is 1,810 in 2013 and same figure in 2012. Own shares held is 8,596 naira in 2013 and 6,200 in 2012. Share option reserve is 2,832 naira in 2013 and then 1,652 naira in 2012. Retained earning is 124,112 in 2013 and 114,372 in 2012. I think that's all. Then the next additional information. The issued share capital of the company consists of 50 kobo ordinary shares. 2. The market price of the ordinary shares was 17 naira at 31st December 2012 and 19 naira 16 kobo at 31st December 2013. 3. There were no preference shares and no loan notes. 4. The cost of purchases plus production cost was 124,966,000 in 2012 and 125 million in 2013. Other opening and closing balances are shown in the question. Do I need to read all?
Yes.
Okay. PPE accumulated depreciation in 2013 was 37,046,000. Then in 2012, 129,540,000. Then in 2012, opening balance was 122,288,000. Inventories closing as at 2013 is 60,548,000. And then closing as at 2012 is 18,344,000. Opening as at 2012 is 20,836,000. Trade receivables is 40,486,000 in 2013 and 37,160,000 closing in 2012. And then opening of 2012 is 20,836,000. Sorry, 35,678,000. Trade payables. In closing of 2013, trade payables was 9,604,000, and closing is 12,882,000. Then opening of 2012 was 11,412,000. Other taxes and social security was 3,862,000 as at closing of 2013. And then closing of 2012 was 3,640,000. And then opening of 2012 was 3,818,000. Accruals stand at 30,740,000, closing as at 2013. Then closing as at 2012 was 27,810,000. Then opening of 2012 was 27,680,000. Equity 129,888 for 2013 closing, and then 121,364 for 2012 closing, and then opening of 2012 106,274. Required. Calculate performance efficiency and investment ratios for each of the 2 years as far as the available information permits. 2. Comment on the company's financial performance for the year ended. Next page, sir.
No, that's all.
Okay, for the year ended 31st December.
Okay. Thank you very much.
All right, sir.
Now let's switch to the Excel, where I try to profile a solution and I also put the questions side by side. Okay, let me enlarge first. Okay, they requested us to first of all discuss on the limitations. Okay, from what we discussed earlier in the day, some of the drawbacks to using financial ratios are what I pointed out. Okay, one of those critical things is issue of operating activities that might be the same or not the same, and its limit comparison. Judgments in presentation of financial statements as required by the conceptual framework and IS1 also might become a limiting factor. The definition of those imputations in each of the variables and ratios may also provide limitations. Differences in accounting policies and accounting methodologies adopted by companies will also provide limitations. Another limitation might be historical data, as we have said earlier, because we use historical costs for our financial statements. Barely do we have all of our assets and liabilities reflecting the current prices, okay? Except for few that we might have fair value. Okay, now all of these are limiting factors to relying on accounting ratios. But upon all those limiting factors, there are ways and manner to which we can address them, which I've explained earlier, which in practice we do those amendments or adjustments before we compute ratios. We don't just compute ratios on the surface of what is in the account, the way it is, except if there are no adjustment to be made because they are comparable, as the case may be. Okay, now in computing those ratios, we are told to compute ratios under 3 categories, I guess so. Calculate performance, which are management efficiency and investment ratio. Okay, these are the 2 categories for the 2 years, okay? And also comment on that. They didn't say we should write report here. They said comment, okay? But let's start with the ratio first. For performance or management efficiency or profitability ratios, okay? I've identified these following ratios. Gross profit margin, as the case it is a ratio of gross profit to sales. And in this account, we have direct information about gross profit, which is not a big deal. We have our gross profit given to us on the platter of gold, and we have our revenue, which is not subject to adjustments. Now, what can we deduce from here is that there is a slight increase in our gross margin. Marginal increase that's not even up to 1% or barely 1%. But our operating profit margin is also higher slightly. And what is that? It's our profit before interest and tax. Now, if you check here, did they give us profit before interest and tax? Not necessarily. Okay, I think they gave us, which is 32, only that they decided not to label it. And I think the examiner decided not to label it so that it's not something that is given on a platter of gold. But we know that profits we have here is before interest and tax, okay? And we have it there. Okay, we have our sales revenue, and we are able to derive this, which means our performance is slightly improved compared to last year. Net profit margin is still far better, which is we are looking at our net profit after all expenses have been deducted. And what is that here? Profit for the period, which is this 24,506 compared to 23,404. And our revenue remain the same as we have adopted them before. Okay, and that is what gave us 9.52 relative to 9.2. Inventory turnover, because we are talking of management efficiency in addition to performance, we are looking at activity ratios. And we look at inventory turnover, which is the ratio of cost of goods sold to average inventory. But in the question, they seem to have given us information about inventory, about cost of goods sold, okay? Yeah. They gave us information about cost of purchases plus cost of production, which shows that this is a manufacturing company. 124,966 in 2012 and 125 in 2013. Okay, where will that be important? Probably in the case we want to determine our credit purchases, okay? But here, what we are even interested in is the cost of goods sold, which we have on a platter of gold. And on that platter of gold, if you check the account here, we have cost of sales, 126,796 and 127,458. Okay, and that is that average inventory. I've told you earlier that we are going to take average inventory as opening plus closing. But if you look at this, they gave us balance sheet of 2 years, which means we can pick inventory value from this year, 16,548 and 18,344. When we add these two together and find the average, it will be average inventory for 2013. But for 2012, we need inventory of 2011. Now, let us check from the additional information whether they give us inventory of 2011. Okay, I think because of the averages, they've assisted us here. You can see here again, they've shown us other opening and closing inventories. Inventory of 2013 closing is 6, which correspond with this. Inventory closing of 2012 is this, which corresponds to this. Now they gave us opening for 2012, which is the same thing as closing for 2011. Therefore, we can now add 18,344 plus 2836. The average is going to give us the average for 2012. Okay, and I think that is how we arrive at it here. If we could remember, average inventory. And you can see it even from this formula here, 16,548 plus 13,344, all divided by 2. And for this, you can see 18,344 plus 2836, all divided by 2. And that is that. And we're able to get our inventory turnover, which is slightly higher than last year, which means all of the metrics we have done so far shows performance of current period is better than last period, but marginally. Average collection period, which means we are looking at our average receivable. Okay, what's our average receivable? Your opening receivable plus your closing receivable, all divided by 2. And I think that is why they give us all of this information, 3 balance sheets. And that's how we are able to determine that, including payables also. Now, upon doing that, what then do we do? Because we are determining it in days, we have assumed 365 days a year. The examiner did not restrict our number of days to 360, and therefore we have used 365. And we have deemed that all sales are on credits, there's no other information to the contrary. At the end of the day, we're able to get 55 days as against 52 days, which means we collect more, our collection is faster last year than this year. Probably, we have given additional grace period in order to incentivize sales, which means for people to purchase more from us, or for our customer to buy more from us. And probably that might have accounted for our reduction in our ability to collect earlier, because we are collecting 3 days later than our average collection period last year. And unfortunately, we are paying earlier, 2 days earlier than we were paying last year, which was 35 days, which means our liquidity will be a problem for this company because it takes us longer periods to collect, but shorter periods to pay our own suppliers. And in this case, what is our credit purchases? We're supposed to have worked it out, but the examiner provided us the credit purchases. If you remember, there was an information here which speaks to the fact that the cost of purchases and production cost was 124,966 in 2012 and 125 million in 2013, which means we didn't go all stretch to work out our credit purchases. As I've shown you in class when we were doing some analysis then. Okay, in this case, we have 33 days compared to 35 days, which have all of this simply explain our performance. The only thing that looks discouraging is our liquidity, all because of it takes us longer period to collect money from our own customers, but shorter period to pay our own suppliers. Now, investment ratios will come again. Earnings yield is the ratio of earnings per share to market price per share. Okay, in this case, they give us earnings per share and market price per share. I think the information is available here. Let's check it here. Yeah, basic earnings per share was given to us, as you can see it here. And we also have market price information somewhere here. Yeah, these are our market prices, 19.6 in 2013 and 17 in 2012. And in that case, we can use units instead of wasting our energy computing in value. Since it's relative measure, you are going to get the same result. In that case, we have 1 naira 30 kobo compared to 19 naira 60 kobo, which means our earnings yield is slightly lower in 2013 with 6.79% compared to 7.37%. Dividend yield is also, okay, it's barely the same, all because the proportion of increase in our dividend per share is compensated outrightly for the proportional increase in our market price, which means this has made no significant difference. Our price earnings ratio, as you remember, is for you to invest this, which means transpose this up and down, and you're able to get our P ratio to be about 14.7 times compared to last year, which means market value was higher than last year, which also can be demonstrated from our market prices. Okay, our dividend payout ratio has been slightly the same at about 30%, even though this year we pay out more, because out of 1 naira 30 kobo earnings, we pay 44 kobo, which gives us about 33.8% in 2013 and 31.15% in 2012, yeah. Retention ratio, as I said earlier, is either you just say 100% minus 33 and 31, which will give you the same thing, or you simply say your earnings per share minus dividend per share will show you your retention, and divided by your earnings per share, you get the same result. Okay, dividend cover is looking at how many times can our earnings pay our dividend, which means we are looking at what is what is our earnings per share divided by our dividend per share shows that our earnings can only pay averagely 3 times of our dividend, which means if we assume all things being equal, nothing happened and we are not doing anything next year, which means we can still pay at least dividend, the same amount of dividend for the next 2 to 3 years to our shareholders, all other things being equal. Compared to last year, which is 2012, we had slightly more by just 0.21%. Therefore, all of these are what we have seen. And except for few exceptions, our performance averagely in 2013 seems to be better than 2012, but I still believe we can do better. Now, what is then the commentary? Remember, you must understand the language of the examiner. The examiner did not say we should write a report, which will be standardized. It's just say comments on the performance. And therefore, in this slide, you are not writing a report, but you are only going to make commentary on what we've seen. I want somebody to volunteer to help me read this commentary. Who will volunteer? Okay. Okay, I've given you access. Precious, I've given you access.
Okay. The analysis, okay, performance efficiency ratios. The analysis of performance via the profitability ratios revealed the performance of 2013 is marginally better than the performance of for the preceding period, 2012, as every profitability measure / ratios showed an enhanced performance, which include gross profit margin of 51% in 2013 to 50% in 2012, operating profit margin of 13% in 2013 to 2012 to 12% in 2014, and net income margin of 10% in 2013 to 9% in 2013. All indication with respect to profitability in 2013 is a clear evidence of management efficiency with respect to efficient utilization of its assets to generate economic benefits. And okay, the analysis of performance via the working capital efficiency revealed increase in inventory turnover from 6.51 times to 7.27 times, while there was evidence of prompt receipts of cash, enhanced collections from customers in 2013, as evidenced by 55 days average collection in 2013 to 104 days in 2012. Furthermore, there was insignificant difference / variation with respect to average payment period to vendors or suppliers, with 2 days shortened payment period observed. With respect to the management of the entity's working capital, there exists consistency in its short-term solvency and liquidity position based on slight improvement. The performance of the entity via its liquidity has continued to demonstrate the company's ability to meet its short-term obligation as at when due. Investment ratios. Could you please take it up a bit? Okay. The analysis of investment ratios equally demonstrated the applaudable performance of the company with respect to meeting investors' expectations as regards its enhanced returns, as shown by increase in price earnings, 14.72 in 2013 to 13.58 in 2012, increase in dividend yield, 2.30% in 2013 as compared with 2.29% in 2012, dividend payout of 34% in 2013 to 31% in 2012. There was a slight exception in performance with respect to drop in earnings from 7.37% in 2012 to 6.79% in 2013. Likewise was a furthermore drop in dividend cover from 3.21 times to 2.96 times. Overall, it is perceived that on an average basis, the market expectation of the investors may have been satisfied based on the analysis and review of the company's performance for 2013.
Okay. Now let's look at ICANN solution. It's not, I think they adopted most of what I have written also. Okay, yes, only that they just added more to it. All of what I explained earlier in terms of homogeneity and heterogeneity, issues about consistency, judgment, alternative accounting methods, management assumption-based and judgments, differences in policies, use of historical data. They now added other ones like inflation. It doesn't capture inflation. If you remember, we discussed it under concept of capital and capital maintenance, issue of current purchasing power accounting, current cost accounting, and historical cost accounting. Now, differences in ratio definitions, I think I mentioned it, use of industry average, and lack of comparability figure for a new entity. Now, all what we have computed earlier was exactly what they adopted. But what I discovered is that they only added two other ratios I didn't pinpoint. Remember, once ratio is not given to you as a list, it's not compulsory that it's the same thing they pick, you pick, but at least you have picked sufficient that is sufficient enough for you to make conclusion, analysis, and recommendation as the case may be. But the beauty of it is that you must arrive at the same result as we have it here. Okay, and in the analysis, I think the exact thing I wrote is what was put there, which you can see all of what I discussed there, and investment ratios, you're able to put those things. And that's just, you are making comments, you are not writing a report, which means you need to understand it so that you don't waste your time when you are not to try to report, you only make comments. Okay, even though the same thing that will have gone into the report is the same thing, but report has a structure and has a formal basis of presentation, which I've shown to you in the earlier problem we solved together. But that is just it, and that is it. Now, listen to what examiner commentaries are always. Can you read this commentary? Who will volunteer to read commentary now? Okay, Brad. Can you read the examiner's report?
Examiner's report. The question tests candidates' knowledge of accounting ratios and the limitations of using accounting ratios in the analysis and interpretation of financial statements. Candidates are required to compute performance, in brackets efficiency, and investment ratio, and to comment on the performance of the entity based on in the computed ratios. Candidates' performance was fair as over 40% of the candidates who attempted the questions obtained up to 50% of the marks allocated. Candidates' commonest pitfall was the inability to identify the relevant accounting ratios, which measures performance and investment of an entity. Some candidates, in addition, had problems with stating the correct formulae for computing the ratios. Candidates are therefore advised to study all aspects of accounting ratios, including its limitations.
Now, let's also look at the one for 2016. Hold on. 2016 was the examiner's report.
It says here, the question tests candidates' knowledge of ratio analysis and interpretation of financial statements. Candidates are required to calculate 8 different ratios and to write a formal technical report to the board of directors concerning the performance, liquidity, and stability of the company based on some computed ratios. Over 90% of the candidates attempted the questions, and their performance was very good. Candidates are advised to keep up the performance. Thank you.
Okay, that is that. Okay, and I think the reason why performance in this year was good is that they listed the ratios for them, which make it easier. Unlike the other one that says compute ratios to address the performance, efficiency, and the investments, which means people may not know which ratio is relevant for what. And that's why the benefit of all what we've done today is that it's not just priming anything, it's to have better understanding and appreciation of it so that you can be able to solve problems no matter how the problem is presented before you. Okay, thank you. And I think that brings us to the close of financial ratios, which means we'll now go back to where we started from. Now, remember, we started from issue of financial ratios. We can now jump into common size analysis, not common analysis, common size analysis, okay? It's similar to ratio, but its own approach is slightly different, okay? Now I'll try and use the same I'll use a question before us here. That is a question for 2016. I'll use a question for 2016 to build up that ratio. Which means let me come here to copy that same question that is there. Okay, now what I'll do first is I'll start with the vertical analysis. And what is vertical analysis? Okay. Before then, let me just construct the account again. Statement of profit or loss. Now, the year 2013 and 2012. have to go in thousands, I guess. Yeah, I have to go in thousands. Okay. Okay, to test everything again, let me just some of this. Okay. I think we got the same figure, yeah. Now let me replicate the same thing for the balance sheets. For my balance sheets. I can merge my property, plant, and equipment together instead of putting it one by one. 69864 plus 115554 and 74630 112. I think that's okay. Then I have my set. Trace, trade, receivables, cash, and assets classified as held for sale. Now, for people seeing this for the first time, when you get to professional, you'll deal with IFRS 5, non-current asset held for sales and discontinued operation. And this is just to prove to you that peradventure a company has to shut down a particular segment or business unit, or try to discontinue the use of a particular asset, and is more or less grossly looking for a buyer. There are some activities we need to do in terms of reporting, given that certain conditions are met. And one of those things is to more or less take away such asset from its normal class and put it within current asset or beneath current asset, where you have to be shown. And once you have such, you have already communicated to the people that, to your stakeholders or investor, that you are selling off that assets or division in the immediate period, not later than 12 months from that period. That's just the significance of that. But there are more to it, which you discuss when you get to final level. So, who can tell me what is the meaning of own shares held? Who can tell me what it is? You can send a chat, send it a chat. You can raise up your hand or send me a chat. What do we mean by own shares held? I'm awaiting your hands. Okay, right. Right. I can see your. Okay, if you're in Chuku.
Yeah, own shares held is it's like refers to a portion of a company's stock that is owned by the company itself.
What does that mean?
I'll tell you what it means. It refers to the portion of a company stock that is owned by the company itself. So it's
Can a
also,
company own part of its shares?
Hello, sir.
no. Well, yeah, it depends on the situation, typically.
What situation can make a company own part of its shares? And is it possible?
Well, on the
Can I
basis of
come in?
3%. I'll let my colleague come in and do the work.
Okay, come in.
Okay, my name is Ifan Chupu. I
Yes,
think
sir.
the only company can own their own share if maybe their number of shares outside in the hand of people is many, and they want to maybe kind of buying it back from people or from buying it back. They can buy their share back from the market so that maybe for any reason they have in their mind. But I think
But can you not say,
back.
if a company buy their share back, does that mean that they own that shares?
Well, I don't know, but that's what I think, buying it back.
Yes, okay. Now, this is to put your attention again to what I call treasury shares. When a company buy back its shares, and such shares are deemed no longer to be outstanding. When we get to earnings per share analysis, I will explain further because it's going to have effects on what we mean by shares outstanding. But first, what I wanted from you is to understand that own shares held is the same thing as treasury shares or shares buyback. Okay.
Oh yeah, that's what I wanted to say. Yeah, shares buyback.
Yeah. Okay. Where's the liability? Okay, I have current liability. And non-current liabilities. What did I miss here? That seems that the balance sheet did not agree. 48, okay, I missed something. 43,773, okay. Okay, yes, it agreed. We can achieve our objective now. Okay, before we achieve, let me quickly switch to our notes. Okay. What is common size? Now, common size is also a relative analysis, which can take a form of vertical or horizontal. Now, vertical is looking for a key factor or what we call a base. A base means a reference point in which every other variable within that financial statement will be referenced to. Now, there are key reference or base points in the two components of financial statement. Now, I'm going to limit my analysis to statement of profit or loss and the balance sheet. I'm not going to extend it to cash flow, but the same principle applies. But the most common relative analysis is restricted when it comes to common size to income statement and the balance sheet. Now, for vertical, we are saying in income statement, what can we consider as a key factor or key variable or base in which every other thing can be relatively measured against? Who can tell me what that should be for income statement and why? You can raise up your hand or you send a chat. What should be the base or the key variable to which every other variable within the income statement should be relatively measured against? Davidson said revenue. That's correct. Davidson, please, can you unmute and tell me why revenue? Davidson, over to you. Why revenue?
Okay, hi everyone. I don't know how to explain it, but I mean everything. Okay, so the income statement, right? Everything flows from revenue. Okay, we deduct cost of sales from revenue to get gross profit. So we are doing our profit. The one for the gross, is it gross margin or what's that? That will calculate. So it's a function of the gross profit over the revenue, right? And
Okay.
like that, just flows. I don't know how to explain it.
Okay, but don't go yet. Don't go yet. I will support you and I'll still give you a task. Okay, you are correct. And it's because revenue is a top line. Okay, every activity is geared towards drawing forth economic benefit. And the top line where economic benefit is drawn from is revenue before it flows everywhere. What that means that revenue is a key factor to which we can base or debase every other variable. Therefore, for vertical analysis of income statement, revenue will be our base factor. Now, David, what will be our base factor for balance sheet or statement of financial position? Or what should be?
Okay, so I think it's total assets.
You think it's total asset? Why?
Oh, sorry, should I say net assets? At this point, I'm not so sure. Boys, I think, should I say, I think I'll just go net assets.
Okay. I won't go your way this time around. I'll go for what you chose first, but which your mind changed. Okay, I'll go for total assets. Why am I going for total assets? Because remember, from the definition of an asset, is an asset that is associated with economic resource that's expected to bring forth that economic benefit associated to it, which means in trying to even generate revenue, it is the entire of your asset you pull together towards ending that revenue. If you remember asset turnover, which is a key management efficiency ratio, do you get what I'm saying now? Because it is the more you are able to utilize your asset efficiently, the more it's going to draw more benefit by way of increasing your top line, which is revenue. Which then means that in that light, I'm going to pick total assets as my base factor for that. Now let's start with vertical analysis now and see what it looks like. Then put it side by side. I'll say this and vertical common size analysis. And what do you do in vertical analysis? Instead of in absolute terms, which is in naira, you do it in relative terms, which is in percentages. Therefore, what do I do? I can copy all what is here. Yeah. But I don't need this. I might say that's all of this. Therefore, what will I do? I'll simply say every variable, starting from revenue, cost of sales, gross profit, up to profit for the year, I'll measure them relatively to a constant, and the constant is the base. And what is the base is still this revenue. And because it's a constant, if you understand Excel, I will lock it with the dollar sign, what people call dollar sign, but this is more or less the constant factor. And for revenue, it will always be 1 or 100%. Why? Because you are referencing it with itself. But what will I do? I'll run it down. I'll do the same thing for 2012. I run it down. Therefore, I can put everything in percentages. And that is what you can see here. Now, what this is simply saying is very simple. It's saying that if your revenue is 100%, 49% of your revenue relates to your direct cost of sales, and 51% is your gross margin, which is simply as ratio of gross profit to revenue. And 38% of your revenue goes by way of operating expenses. And 1% of your revenue represents additional income you have. And 13% of your revenue represents your profit before tax, which means for every 1 naira you make, 13 kobo is your profit before tax. While 4 kobo is your tax for every 1 naira, and 10 kobo is your final profit that belongs to the shareholders. That's what this is trying to say, which make more meaning and sense than this absolute for decision making. And if you look at it at a glance here, without computing ratio 1 by 1, I can tell you which year is better than which year. Can you see the beauty of common size? Which means it has a beauty over financial ratio, because what you are taking time to do in ratio 1 by 1, trying to explain, you can explain it in a pictorial form, just with one analysis. Which means, all in all, you can find out that what has made us to perform well in this case, who can tell me the function within an organization that's supposed to be applauded or given kudos for marginal performance we have made in 2013 to 2012 in this scenario? Raise up your hand. I think Ifan's hand is up before. Okay, I think I'm not taking back to the sheet.
Yes, sir, that's what I was raising hand for.
Sorry. Okay, this is the sheet.
Okay, sir.
Let me quickly take it back. Sorry. Okay, what I did is revenue, every variable, this like that to the end, you are going to measure them relatively to revenue. But I'll still start with revenue because it's the first line. But there's a constant, and what's that constant? It's still the same revenue. And I locked it. If you understand Excel, this lock means you have more or less make it a constant. And you give me 100% or 1. If you give me 1 like this, I can convert it to 100% by bringing a percentage. That's what I've done. Now, what would I do? Because I've made the numerator a variable. Variable means it changes as I move on. But the denominator is a constant. Constant means it's only a base, a factor, which is revenue. Therefore, I can run it down like that. And this is what I've done. The same thing I do for the second year. And I run it down. Okay, every other thing I did is just formatting. Everything I did. And I'm saying that if my revenue is 100% or 1 naira, I'm saying that my cost of sales is 49% of that 1 naira, which means for every 1 naira I made, I've actually purchased that item for 49 kobo. And that's why I've made 51 kobo for every 1 naira. And of every that 1 naira, I paid 38 kobo as operating expenses. In addition to that 1 naira, I made 1 kobo by way of other income. And for every 1 naira, I've made profit before tax of 13 kobo. That's what 13% means. And of which I pay 4 kobo for every 1 naira revenue I generate. And at the end of the day, what serves as earnings to my shareholders for every 1 naira is 10 kobo. That was for 2013. 2012, for every 1 naira, 50 kobo of it goes by way of my cost of sales. 50 kobo goes by way of my gross margin. For every 1 naira, my operating expenses remain constant as 38 kobo. My other income remain constant at 1 kobo. My profit before tax remain constant at 13 kobo. My income tax remain constant at 4 kobo. But my profit for the year, which is due as earnings to my shareholders, reduced to 9 kobo compared to 2013. The question then is, what has made, or which organic function within the business has made 2013 better than 2012, given that our shareholders now earn 10 kobo for every 1 naira as compared to 9 kobo for every 1 naira? Who can tell me what contributed to that? Cost of sales. Yeah, cost of sales, but which function will be responsible for that is our purchasing department or procurement, which means in this case, nothing has changed other than performance, which means I'll give kudos to purchasing or what we call procurement, which means they might have taken into strategy of economic of scale, or import substitution, or product substitution, or looking for other suppliers, and this has brought advantage to us. And every shareholder will be happy that you have added 1 kobo to the 9 kobo. And that is a plus, which means from here, at a glance, I can tell you that the whole of the improvement in performance can only be narrowed down to procurement and purchase. And that is the beauty of common size. In this case, this is vertical. Let us now replicate that vertical for our balance sheet. As we have said earlier, for balance sheet, we said total assets will be our factor, which means every variable has a ratio of total assets. and I'll lock it as a constant. And I'm going to run it down to everything. For 2012, also, every other line is a variable, and I'll lock it by dividing it with a constant. Every other thing I want to do is just formatting. And I can put everything in percentages. Now, I think you can see it at a glance now. Now, I can see at a glance that for every 1 naira of my total asset, I only have 7 kobo of it in plant as investment in plant, property, plant, and equipment, as against 40 kobo. And the reason for that reduction might be attributed to 1, depreciation, assuming there are no additions, impairments, assuming there are no additions, or disposal, in addition to depreciation. Now, my inventory level is lower, which is a plus, because everybody wants to have a low inventory level, because keeping more of inventory is tying down more of cash, even though there's an advantage to keeping inventory at some point in time in order to avoid stockouts, because in life there's a trade-off to everything. And also in case of anticipation of inflation, it's also good to tie inventory. But again, you have to do your maths, and your risk management and your inventory management system must be robust enough to take the appropriate decision. Okay, my trade receivable. What can you deduce from here? What you can deduce from here is that you demonstrated poor collection, which corroborated our ratio we calculated here the other time. Remember, 52 days before, now 55 days. That has affected our liquidity, which is corroborated by this analysis here, that before now, of every 1 naira of our assets, we only owed about 3 kobo of it in receivable. But now, we owed about 2 kobo of it before in receivable. Now, 3 kobo, which means probably our credit policy system needs to be revisited, or our collection management system is deteriorating. Therefore, this depicts that picture, which also you can see from our cash position. Because inventory level reduced, which means we should have improved cash position, but we are having reduced cash position because this position worsened. And therefore, we can see where our liquidity issue is coming from, which means we need to address our credit policy system. Or let me just call it credit management system. That is more extensive. And collection efficiency. Therefore, in this case, our marketers will be given a knock instead of kudos. We knock marketing team, marketing assistant. Okay, take note of that. Those are the benefits of on the glance. On the glance, you can see that our level of leverage is increasing marginally because it seems we have a capital reduction, which is not, it's just relative measure because our net asset has grown, but our share capital remains the same. But when you look at it from equity perspective, it's increasing, which shows a good performance, just because we are able to retain more. First, before you retain, you have made more earnings, and you're able to retain more of your earnings. Okay, and it seems we have a pattern of buying back our shares, which means there is a pattern attributable to capital reduction. And there are many reasons for that, which I will explain some of them when we get to analysis of earnings per share. But if you get a professional, or if you watch my video on share-based payment scheme, you will appreciate more why such happens, which means it's not always a bad thing when it happens, but it happens for various reasons. Somebody mentioned one of the reasons, but probably when we get there, I will explain it. Okay, this kudos for good performance. Management efficiency and good performance, because if not, it's either your retained earnings should remain constant or reducing, but rather it's increasing, which shows a good performance by management. Your liability, yes, this is also good because you are able to maintain your current liability and even your non-current liability, which means liability management is not a problem. It has remained relatively constant, which means at a glance, I can simply see that there are about 4 or 5 key things I can deduce here. One, we need to encourage more of efficiency from our purchasing procurement. What strategy they've adopted, if they can keep up with it or improve further on it, it's okay. We need to knock our marketing team. Probably we need to move on and diversify our customer base, or try to more or less rejig our credit policy and credit management system. Also improve on our drive towards collection from customers. Okay. Also, what is bringing about this capital reduction? Let us investigate. Is it as a result of share option scheme? Because I can see share option scheme here for employees, I suspect, and some other things like that, which is something I'm still going to explain to you later when we get to analysis of earnings per share. Okay, but bulk of it, you will have enjoyed it under employee benefit and under share-based payment, share-based payments under IFRS 2 and employee benefit under IAS 19. Okay, but those 2 things are for final level. But you can watch the video if you want on YouTube if you have interest on them. And also management efficiency, there's a good performance overall from management in the more or less management of affairs of the company and their retention policy towards growth of the business. And this is the beauty of what it is, the vertical analysis. Now there's horizontal analysis. Now, what is the difference in it? Horizontal analysis is synonymous to what we call trend analysis. Now, let me do that in between here. Because I only have 2 comparative periods, I can only do trend for a year as an analysis, which means I'll come here, horizontal. This is all green. Below that, horizontal. How do I put blue? Okay, what is horizontal analysis? It's like a trend. Trend in the sense that I'm comparing my 2013 with my 2012. That's horizontal, which means I'll look at it and say, what is the ratio of 2013 to 2012? Once you give me this ratio, this is not what I'm interested in. I'm interested in the change, the degree of change, or what we call the percentage of change, which means I'll now subtract 1 from it. And it will give me that it has only increased by just 1.12%, which means my increase in revenue between 2012 and 2013 is just by 1.21%. And I'm going to replicate it for all of the periods in that manner. I can do it for as much as 5 years, as the case may be. Therefore, I might leave it like this, and I must swear it like this and put it in. Blue. Okay, now, as you can see it here, at a glance, you can see the reason why we made marginal profitability against last year is because revenue increased marginally by 1.2%, whereas cost of sales equally reduced, not even increased, marginally by 0.5. The combination of those two benefits translated to what we found here, which now made averagely our gross profit to increase marginally by 3% on a year-on-year basis. Though our expense look as if it is the same thing here, but you can see it here that marginally our expense increased between this year and that year by 2.3%, which is more than compensated for by increase in this gross margin by 2.9%. That is why it is not obvious for us to see it here. But if I extend it further, you might see a little difference here, 38% and 37.6. Probably I should just do it to 1 decimal place. So that I can see that it's not exactly the same in that light. Okay. Now, our other income increased by 48%, only that in absolute amount is a small amount relative to this big number. Even though it jumped by 48%, but it's so insignificant because the entire amount itself is not much. Though relatively it looks big, but the impact is low because of the absolute amount compared to other amounts. Now, our profit before tax increased by 6.7%. Our tax increased by 11.8%, which forced our profit for the year to drop to about 4.7% increase year-on-year basis. Now, the same thing happens to assets and liabilities. Okay, you can find out that our capital will not change because we have not issued additional capital. But over time, we have been experiencing increase or upward trend in our treasury shares, which can be more or less likely to the fact that there is employee share option. Okay, and our retained earnings has marginally increased by 8.5%. Our current liability, you can see that they have no significant effect, as I've said earlier, and that is just it. This is horizontal analysis. And if you do this across the years, which means, supposing we have 5-year financial data, you will now compare also 2012 to 2011, compare 2011 to 2010, compare 2010 to 20 this, and you can do that. And on the average, you can compute your compound growth average rates over the years to say, in the last 5 years, how have you grown? And you can use that to forecast into the future or do what we call your financial modeling. Okay, and that is that. Any questions so far? Someone say he doesn't know how, or he or she doesn't know how I arrive at the horizontal movement. Okay, let me show you. I think my pen should work now. How do you compute change? Your change, your percentage change. What's wrong with this pen? Somebody has once told me on the chat that probably my village people are the one around me. Okay, help me cast them out. Now, percentage change is my current year minus my previous year over my previous year, which is the same thing as saying my current year over my previous year minus my previous year over my previous year, if you understand arithmetics or mathematics, which means this will cancel this. Let me pick this pen. This will cancel this, which is 1. Therefore, I now have my current year divided by my previous year, everything here, whatever you get here, minus 1. That's what I've done, which means ask yourself, what is the change first? Okay, probably I should do it for you like this. I'll say, what is the change? This is symbol for change. What is the change? What is the change between 20? This is the difference between this and this is the change. Now, what then is percentage change? Is this, which is the difference, divided by this, which is this. And when I format it, you get the same thing. Let me take all this out. You get it mathematically now. That's what I've done. If you want to do it in your way, it's the same thing. I'll give you the spreadsheets. It's just normal percentage increase in whatever you are doing. I believe that has cleared the course for us. Okay, I've attended to Redmi. That's your question. Who else? Any other question? Any other question? If I, over to you.
Okay, sir. It's not like a question, but I don't want to be clear. What he meant to be shares option reserve. Is it what is reserved for the employee to enjoy when the time is right?
Okay, it's not something I can. I've explained it when I was taking you conceptual framework, and it's also in the material provided. But the better explanation is when you get to IFRS 2, share-based payments. Okay, where we'll be discussing on compensating people, mostly your employee or even your supplier, with your shares as a form of consideration or with a consideration in cash that is based not on the value of what they've delivered, but the value of your shares. And that's why I said it's not for your level, it's at the final level, which is corporate reporting, or the final level of ACC, which you call strategic business reporting. But I'll give a clue about it when we get to earnings per share. There's a standard to it in which treasury share is instrumental to a critical aspect of computation of EPS. And in that time, I will have sufficient time to give you some explanation, a little about it. But for now,
is there
what?
Do you have any video with which I can watch to understand it more?
Yes, I've said it earlier. I said if you go on my channel on YouTube, you will have like 2 to 3 parts where I have dedicated video models and everything for share-based payment transactions, IFRS 2.
Okay, sir.
I've said that earlier. Somebody saying explain vertical again. I think I've taken time to explain vertical. It's more easier because you are only comparing each line item with revenue, which means each line item divided by revenue will give you your vertical numbers. And that is for income statement. And each line item in your balance sheet as a ratio of total assets will give you your numbers for the balance sheet. I think that is clear enough. Okay, but again, you have access to the video and you still have access to the material to look at it once again. Now let's go back to our material. If there's no other question. Multi-variate analysis. Okay, we'll wrap it up with this, okay, and graphical analysis. Okay, but let me quickly go to graphical analysis and we'll come back to multivariates. Vertical analysis, graphical is just pictorial, or what we call today visualization or infographics, which means using picture, using charts, using pattern in terms of objects or design to depict the direction of events when it comes to measuring performance of a business. And therefore, we have a lot of chart into this world beyond what I've displayed before you that we use in order to picture at a glance. And you know what happened? Based on biological neuron and its neural analysis, it has been concluded that whether you are educated or not educated, whether you are brilliant or not brilliant, whether you are black or white, you tend to have similar understanding or picture of what things are when it is presented in pictorial form than when it is presented as an analysis or as a report or as a financial statement or as whatever you want to show it. Which means you don't require, how will I say it? You don't require a special skill to understand what is good from what is bad when you see picture. For example, if you look at the picture of this pie chart, nobody will tell you that what you are simply saying is that this thick blue is fixed assets, or what you understand as tangible assets or PPA. He has taken a chunk of the pie, which means everybody can understand that, no, that means this part has taken bulk of the pie. And in that case, it's important. In that case, people can ask you, why is it taking more of the pie? Why are you having bulk of your assets? Because it's like asset pie chart. Because when you see all of the variables, they are fixed asset, investment, stock, debtors, and cash. It then means that your fixed assets are taking close to about half of the chart. The question then is, why? Is this business much more of tangible asset or not? And other things. You can see level of investment, level of cash, and all sorts of things. And if you don't want to look at it from the chart, you can also look at it from the bar chart. You can also see that it's the fixed asset is the tallest of them all, which also speaks volume to say, of my assets, both of them are in fixed assets, followed by debtors, followed by investors, and some other things like that. Similarly, you can also present it in other manner, which says that, okay, let me look at it year on year. What has been the pattern? You can see that fixed asset is blue. Stock, debt, okay, fixed assets is blue. Investment is purple. Stock is, I think stock is green. Debtors is, I think, red. And cash is the smaller blue. And you can see that pattern. You can see a line chart. What you are just trying to look at is to say, when you see picture, you can see when this is going up, is coming down, and you can be able to make more informed decision about it, in addition to whatever explanation or information given to you, which is just like pictorial representation of an analysis, and which makes it much more easier to some people in the way and manner they do things. Okay. That is that. Now, let's now go back to the final analysis, which is the multivariate. Now, multivariate analysis is saying that instead of, because ratio analysis is looking at two variables compared together, or two batch of variables, one batch numerator, one batch denominator. And for you to have a holistic view about certain things, you need to compute as many ratios as possible and look at the directions and patterns and make recommendation or make conclusions. But in this case, we will be looking at more than one ratio in making interpretation of the likelihood of corporate failures in the future. Which means, apart from the fact that this analysis is going to take more than one ratio at a go in its evaluation, its objective is not much more of performance measurement, but it's much more of predicting likelihood of bankruptcy based on pattern that has been established in the past. The question then is, we have various theories, starting from the most common one there, which is the Z-score, Atman Z-score, okay? We have various theories. We have Atman Z-score, we have Taffler Z-score, we have Zeta Model, you have performance analysis score, we have the H-factor scoring and the A-factor scoring. Now, let me just simplify it to you. What they are trying to say is this. In the past, where they make use of data existing between 1960, I think 64, 65, 60, up to the revised section in 68, they've looked at historical data. And the historical data is to establish that what combination of factors were traced to corporate failures. Which then means that if those factors continue to recur in every corporate failure, it then means that we need to watch out for those factors and predetermine them in any entity in order to establish whether such entity will result in a corporate failure. Okay, and that's what we're trying to look at. And in looking at that, there are various things that they've seen over time. Some of those factors are things like increase in market capitalization over a period of 12 months, increase in revenue over an accounting period, return on net worth, compound growth rate of EPX, price earning ratio, market capitalization, sales for last financial year, profit, all of those things. And in the first assessment, they use like about 20 companies within those categories, and they carry out analysis to understand what is the likelihood of corporate failures and corporate success. And if you look at this aspect, Peters and Waterman, in the search for excellence, identified these following indicators. Their own indicators they identified, which is like a pattern, borders on compound asset growth rate, compound equity growth rate, the ratio of market valuation of business to its book value, and your return on equity vis-a-vis return on sales. Okay, and they have used some of those measures to forecast bankruptcy of companies, which seems to have worked. Okay, and in summary today, we have about 5 or 6 of them models that can be used, but the most popular out of them is Atman Z-score, which is probably the one I'm going to use now. And if you look at it from what the theory or the history is, or the literature, is that it was first developed by Professor Atman in 1968 and further modified in 1977. In the study, Atman examined a sample of 33 bankrupt firms with a pair of 33 non-bankrupt firms, which means it tried to balance the data set. 3 corporate failures, 3 corporate successes. Now try to extract insights from them. He considered 22 accounting and non-accounting variables in various combinations as predictor of failure. And he was able to come with a conclusion of this linear function. The linear function has 5 coefficients and 5 variables. The coefficients are derived from regression analysis, while the variables are factors drawn from the business insights and pattern observed over time. But those factors are much more ratios in nature. And what are they? Now, for example, the first factor of variable 1, x1, is the ratio of your working capital to total assets, which seems to measure the liquidity of an asset of a business. The second one, let's see whether I can enlarge it. Okay. The second one is X2. X2 is the ratio of your retained earnings to your total assets, which measures your reinvestment of those earnings. The third ratio measures relatively your profit before interest and tax as a ratio of total asset, which measures your profitability. Remember, the first ratio, X1, is working capital efficiency. The second ratio is reinvestment opportunity. The third ratio, X3, is profitability measure. The fourth ratio is based on financial leverage, which measures the ratio of market value of your equity to the book value of your debt. And the last ratio borders on asset turnover or asset utilization, which is a measure of your sales to your total assets. And what is the benchmark for these two? The benchmark is based on a timeline. And what is a timeline? Is that Atman identified two benchmarks. Companies that score 3 and above are unlikely to fail and should be considered safe. While company that scores between 1.8 and below 1.8, sorry, are very likely to fail within a couple of months or years. Whereas there's a gray area, companies that score between 1.8 and 3. They are on the edge of where we might be unable to say whether they will fail or they will not fail. Okay, but again, this projection, once you understand it, a company can trigger actions to counter it, especially if you fall below 1.8 or you fall in between 1.8 and 3. Now, but further to 1977 revision to the model based on updated data of new failures and otherwise, the value of 3 was further reduced to 2.7, which means if you score 2.7 and above as a Z-score, you are unlikely to fail. Whereas if you still score between 1.8 to 2.7, you are in a gray area. But if you fall between 1.8 downwards, you are more likely to fail if actions are not immediately taken. And the question then is, the 1968 work is claimed to distinguish between successes and failure up to 2 to 3 years before the event. Whereas the 1977 revision of the model based on updated data claims an improved prediction period of up to 5 years before the event occurs. Now, there's another modification to it, which is the Taffler Z-score. It's just a slight modification. Its own is that it has the constants here, which is a bias, plus other coefficients, which is C1 to C2, okay, and also have its own variables. In this case, you only have 4 variables, which are ratios. X1, this would ratio of profits before tax to current asset. X2 deals with liquidity, current asset to current liability. X3 deals with current liability to total assets, and X4 deals with no credit interval, length of time. The company can continue to finance its operation using its asset to tap revenue inflows. But again, this is less used compared to Atman. We also have Zeta, you have pass, you have H-score, and we have A-score. But in this case, we are going to use Z-score for the same data we have here. Now, let's look at this Z-score. I'll just copy it and paste it. Okay. Okay, let me switch back. Now I'll use the same data. As you can see here. Let me just put what I copied there. Which means what I need is, I need these following factors. X1, X2 to X5. And what are they? Financial measures, or what you call financial ratios. What are the measures? If you remember, here I need X1, working capital. Working capital as a ratio of my total assets. Now, X2. X2, if you remember, is my retained earnings as a ratio of total assets. X3 is my profit before interest and tax as a ratio of my total assets. 4 is my market value of equity as a ratio of the book value. Yes. And 5 is my revenue, sales revenue, as a ratio of my total assets. Okay. Now what do I do? What's my working capital? Let me just do for 2013. My working capital is current assets minus current liability. And my total assets is this. It means, what do I have here? This is what I have. Let me just make it in that decimal point. Let me make it 4 decimal. Okay. Now, here my retained earnings is this. and my total assets remain the same. Now, what is the coefficient drawn from this? Oh, sorry, the variable drawn from this is this. Now, my profit before interest and tax, there's no interest, which means this is the same thing. And my total assets. My market value. Okay, did they give us market value of shares here? Okay, yes, I have my market value, 19.60. I think we did computation of it before now. Where is it? What was my market value then? We did somewhere here. Okay. Yeah, that's 19.16. Okay. And how many shares are there? I think, okay, it's 50 kobo per share. Therefore, 19.16. Which means, first, I'll determine the number of shares. 9, what I have, the share capital is 9730, yeah. 9730 divided by 50 kobo will give me the number of shares. I'll now multiply it by 19. What's this? 9730 divided by 50 kobo. I'll now multiply it by 19.16 kobo. Okay. Book value. Now, what is wrong with this? So, $9,730 divided by 0.5 times 19.16. And what is the book value of debt? That's the current liabilities. No, sorry, not current liability, not current liability, not current. In that case, what do we have? And finally, we have sales revenue divided by total assets. Now, if that is the case, now if you come back to our formula, what's our formula? This is our formula. I can slot it in again. Let me enlarge it. Therefore, what will I do? I'll say my Atman Z-score. Atman Z-score for 2013 equals what? Now I have what? That's 0.12 of this, which means is 0.12x, which is this. Plus 0.014 of this, plus 0.033 of this, plus 0.006 of this, and finally 0.99 of this. Now recall okay, therefore, what is my z-score? My z-score is to sum all of this together. Now, what can we say about this company? Okay, first one is 0.012, not 0.12. Let me check. Okay, 0.012, yeah, thank you. 0.014. 0.03, 0.006, and 0.999. Okay, now this score, let me put it in two decimal places, is 1.23. Where does it fall within the range? Let's look at the range. Let me say this is a line. Also, this is 4.8. This is 2.7. $1.8. This is 2.7. Now, where does this company fall? What's the name of the company again? Atman PLC. This Atman. This is called timeline. Now, the company falls somewhere here. Atman PLC with 1.23. Therefore, if action is not taken, even though it's performing a little bit relatively better than itself, it's likely to fail within the space of 2 to 5 years. All other things being equal. And that's what we're trying to look at. Which means we also use this to predict possibility of corporate failures or not, if there's a need to take drastic action. And I think it's the same question that portray issue of economic issue. I don't know. Would that mean that the management of this company need to put something in place and ensure that the company is revived? All up because the metrics. Supposing we know it's comparables, probably it will be obvious that the company is not performing to expectations. Okay, but in this case, this is just it, assuming all what we have done is correct. One of the problems is earnings is relatively low to total asset and its market capitalization is extremely high. Okay, that is that. Any other question before we call it a day? You now have 30 minutes to go for a break as your other lecturer will come in by 4 o'clock. God's willing. Okay, any other question, any contribution? We are able to go into earnings per share today. Probably another virtual session will be used to do that. I thought I'll be able to introduce a little of it, but again, time is not on our side. Okay, Ifeanyi, Chifu. Over to you, Ifeanyi.
Good afternoon, sir.
Yeah, afternoon.
Okay, it's not a question I'm asking, but I know that it might be in the mind of everybody in this class. This last session you taught us now, is it examinable or just for our knowledge?
Okay. Let me confirm. You'll be shocked that I'm saying let me confirm. I'll confirm because if it's in your syllabus, don't worry, I'll show you now. My mind is so clear that it's impliedly in your syllabus. Okay? Oh. It's, for example, last diet, they asked you on blockchain. And this was something I even discussed passively in class then. That is for last diet's class. And some people would just look at what is our concern with blockchain. But when you got compulsory question, 10 marks, some people don't even know what it is. And that's why I took time to explain, to even take it seriously with you guys this time around, and also did ebook on it for you guys. I believe you've also read it. Okay, I can syllabus. Because one of those things I told you guys is the first thing you need to study is your syllabus. Okay. No, let me go directly to this and break it down. Well, I can, let me just go try to search. Some of you don't even know that I can have a lot of resources for you guys. Syllabus information guide. I think it's here. Is it here? No, okay, syllabus is here. Can you see what I'm doing?
Yes, sir.
Okay. Page 51, I guess. Now, this is your syllabus for, can you read it out for me? Analysis and interpretation of financial statement, 20%. Can you read it?
Can you make it bolder?
Over to you.
Okay. Analysis and interpretation of financial statements. 1. Analysis of financial statements. 1A. Identify and discuss types of analysis and interpretation of financial statements.
Since your network is poor.
Are you not hearing me, sir?
Yeah, okay. Start again,
Hello,
please.
sir.
Start again.
Analysis. Okay. Analysis and interpretation financial statement. 1. Analysis of financial statement. 1A. Identify and discuss types of analysis and interpretation of financial statements. B. Discuss various aspects of financial position, performance that may be assessed, in bracket, profitability, liquidity / solvency, gearing, investors' return, bracket close, through analysis and interpretation of financial statements. C. Define ratio. Identify and calculate various types of ratios used in assessment of financial position and performance for a business entity. D. Analyze and interpret computed ratios and assess current period financial position and performance of business entity. This thing is blocking it. Let me just. D. Analyze and interpret compute ratios and assess the current period financial position and performance of a business entity in comparison to I, is period, II, another given entity for the same period, and II, industrial average for the same period. E. Analyze and interpret computed ratio and assess the current period financial position and performance of a simple group, in bracket, one subsidiary and associate, in comparison to I, is period, II, another given simple group entity for the same period, and II, industrial average for the same period. E. Discuss the use of statement of cash flow in assessing liquidity and compare its usefulness with that of a statement of profit or loss and other comprehensive income when assessing liquidity and going concern of a business entity.
Continue.
Okay. Regulations and examination syllabus for ICANN. Explain the use of earning per shares EPS in assessing the performance of corporate entity in the capital market, a special capital market reaction to earning announcement. Hey, where necessary, write report as may be required when analyzing and interpreting the financial position and performance of a business entity and simple group, drawing conclusion, making recommendation, and giving advice from the perspective of different stakeholders. 2, limitation of analysis and interpretation of financial statement. A, discuss the limitation of historical financial information in the analysis and interpretation of financial statement. B, explain how financial statements may be manipulated and discuss the impact of window dressing and creative accounting on calculating ratio and how they can distort analysis and the interpretation of financial statements.
Continue.
You have to go move it forward. Okay, C, explain how analysis and interpretation of financial statements of specialized and non-profit organizations differ from those of profit-oriented organizations. Explain why earning per shares trend may be a better indicator of performance when compared with a company's profit trend, and discuss the limitation of using EPS as a performance measure. Explain why and how the use of consolidated financial statements might limit analysis and the use of interpretation techniques. Discuss the use of other information, including non-financial information relevant to the assessment of an entity's performance.
Okay, that is all, which means, again, no knowledge is lost. In case they smuggle it in for you, so be it. And in case they don't smuggle it in your exam, you have that knowledge. And I think if you check your ICANN syllabus, ICANN text, I think they discussed it. Is it in your ICANN text? You can check. Okay, ICANN text. I don't think I have it here. Okay, I think this ICANN textbook. No, this ICANN question, not textbook. Okay, but again, as it is, you can see how elaborate it is. Don't leave any stone untouched. What I'm telling you this is this. Look at your syllabus here. Where is it? Okay, look at it here. Also, they told you to consider ethics and current development, discuss and apply ethical issues, which they tested last night, discuss development around inclusion of non-financial information in financial reporting, discuss new accounting standards in issue as may be specified from time to time, discuss the application of blockchain and related technology. Now, somebody is asking me that, because I said there's ebook on technology I gave to you, and it seems the person is not aware. Let me show you, probably you'll be aware. Okay, this
That are we
is
also.
no, that means you don't take note of what they share with you guys. I haven't mentioned it in class. Can you see it here?
Yes, sir.
Yeah. Digitalization of financial reporting system and harnessing technology. Okay, there I discussed digitalization, data structure, blockchain, virtual accounting, remote working, RPA, which is robotic process automation, cloud computing, and financial reporting tools. And you can go through them. I can share it again to your platform. You sit there where you can look at them and have knowledge of them. Okay, but I've discussed some of them in class, especially blockchain and some other ones there. Okay. Okay, that is that. Okay, in absence of none, I think we can call it a day. But before I call it a day, now one of those ones that I didn't put here is ChatGPT, which even Microsoft has now incorporated in Microsoft Office 365 with the principle of code pilot using GPT-4 generative processing, what's it called? Transformer, okay? Now, let me show you how ChatGPT might write your ICANN exam and pass. Okay, let me switch here for you that you can see it. Okay. Now, let me pick ICANN question. Let me pick one of these ICANN questions, and let me see whether ChatGPT will pass the exam. I have ICANN question with me here. Now let me look at one of these ICANN questions. Okay, let me show you the question here, and I'll copy the question and paste it, whether it's going to get it right for me. Now look at this question here. I don't think this is copyable, and I don't have the luxury of typing. Let me see whether it's copyable. Now let me take it back to ChatGPT. Let me see whether it copied. Okay, it copied. Okay. Now this is a question. Now the company owns a building which it has been using as head office in Abuja and so also story. Let me see whether ChatGPT will answer the question. Required write a memo to management of Body Limited explaining how this transaction should be accounted for in the financial statement. Provide relevant calculation where necessary. Is already writing the memo? Can you see it? Does it shock you guys? Let me allow you guys to unmute, all of you to unmute since we'll come towards the end. Okay, can you see the answer?
Wow.
I'm writing to provide guidance on this head office line with the company account policy. As for the information provided,
I don't know what which one.
hello, listen, please, let us mute. I'm writing to provide guidance on accounting treatment of head office building in line with the company accounting policy of using fair value model for investment property. As per information provided, the head office building was depreciated over 50 years with an original cost of this as at this. However, on 30th June 2015, the management decided to move the head office branch in Abuja in order to reduce costs. And this, as at this, an independent value assesses to this. Therefore, the head office should be revalued to its fair value of this. As at this, the difference between the carrying amount and the fair value should be reported in profit or loss as again. The calculation is as follows. Fair value of head office is this, and you can see what you take 30 minutes to do, he has finished, and he has written reports. Does it shock you guys?
No, it didn't shock me. Well, it's what is going on at home.
Okay, let me give you another one. No, you won't appreciate it until, let me show you another one. You know, if ChatGPT enters the exam hall, in 5 minutes it has finished.
Exactly. I wish it was possible, but it's not possible.
Now let me copy this. Okay, I want to copy. Okay, no, this is too much. Let me just copy this. This one is enough for me. Explain this. Okay. Explain the following, stating the importance to investor in the evaluation of financial performance. You've earned your 6 marks straight. Okay, let me find another one. I can copy this, but because this PDF is not something friendly.
Okay.
Yeah. Okay, let's look at this. Look at this also, question 5.
Say sorry to that. Okay.
Therefore, what will you say about this? See how you answer once and for all.
Easy.
Easy peasy.
And the beauty of it is that if all of us put the same question, it's not going to give us the same expression,
Answer,
but
expression, yeah.
Answer will be the same, but expression will be different.
It's better to paraphrase it.
Wow.
Still, yeah.
But can
Can
this
also
solve
be
mathematical problems?
Yes, it can solve.
Yes,
Let
it
me
can
show
solve.
you. I can tell you what is the value of X given that X raised to power, let me just give you simultaneous equation, X raised to power 2 plus 3X minus 5 equals 0.
Wow.
Did you see it?
Even with workings.
Yeah, it's show you working.
Now it can write code for me. Write a Python code to draw a triangle of 6 levels.
It will not take long.
Are you serious?
Yeah, it's like a machine.
Wow.
AI artificial intelligence 2.0. That's what I call it.
Way to go.
Wow.
Wow.
This is more powerful than
Can
Google.
you
Yeah, more. This is much more powerful. I don't
Python to draw a love shape?
So you didn't say that you draw very well. But
You've heard of ChatGPT now. Bastard online.
you can even use it for your workplace.
So
You can,
we
without
dey
any
test,
stress.
we just use different things.
Wow.
The one that is taking us this class.
Okay. Thank you very much.
We were just
And
talking
God
about
bless
it.
you
Let's
guys.
just try it again. He didn't want to.
Thank you very much, sir.
Class members that is this
Yeah.
but I
Try
said, okay,
it
let's
anyway.
try another thing.
Okay.
ChatGPT now.
Take care. Bye-bye.
Thank you, sir. We really appreciate
Thank you very much.
There's another one too, but
Don't
that's by
pass.
the way. Thanks by the way.
Exam of 3 hours. If you use